Hello everybody. Welcome to this English revision series for CA Final Direct Taxes and International Taxation. I hope you all are doing really well. In this video, we will be covering chapter Income from Capital Gain. Right away, starting from charging section till all the tax rates, we will be done with this complete chapter. And we will be incorporating all the amendments that are applicable for your attempt. What you have to do, just sit back, relax, and focus on what I am saying. Right away, starting from charging section 45(1), what it says: any gain arising from transfer of capital asset shall be taxable under the head capital gain in the year in which transfer took place. You have to identify the capital asset first of all, then you have to see whether transfer takes place or not, and then you have to charge tax under the head capital gain in the year in which transfer takes place. Now we have four definitions under consideration as per charging section. First of all is capital asset. So what is capital asset? You need to remember three things. You need to remember three things are capital asset. All the assets are capital asset. First of all the assets are capital asset. Oh my God, sir, how all assets are capital asset? Provision says all kind of assets. So a kind of pen that is in my hand is a capital asset. Mic is a capital asset. My mobile phone is a capital asset. My clothes are capital asset. This includes all the assets that are capital assets, but you have to exclude four things out of it. Four things are to be excluded from all the assets. First of all is stock in trade. Any stock in trade for business will never be considered as capital asset. Second thing, any kind of movable plus personal asset. Any asset which is movable plus personal. For example, my television, my clothes, my pencil. This is movable or personal. If it is movable and personal, in this case, it will not be capital asset. Third asset that has to be excluded from the definition of capital asset is rural agricultural land. And fourth is gold deposit bond and deposit certificate 2015. These four things are to be excluded from the definition of the capital asset. Rest all the assets are capital asset. Now, because of this definition, certain assets like drawing, painting, jewelry, sculptures, archaeological collections, any other form of art, these also become capital asset. So, provision specifically, explicitly excludes them from the definition of the capital asset. So, till now, what we have studied, sir, any asset is a capital asset, but any kind of stock in trade is to be removed. Any kind of movable plus personal asset is to be removed from definition. Any kind of rural agricultural land is to be removed, or any kind of gold deposit bonds and deposit certificates are to be removed from the definition of the capital asset. Things to be taken care of is jewelry, drawing, painting, sculptures, archaeological collection, any other form of art will always be considered as capital asset. Next thing that is to be considered for finding out capital asset is any securities which are held by foreign portfolio investors or foreign institutional investors is always capital asset. Even they buy and sell on the same date, even they buy today and sell tomorrow, even they pretend to hold them as stock in trade, but they will always be considered as capital asset for foreign institutional investors. This is the second thing. And third thing, any ULIP to which exemption under section 1020 does not apply. Any ULIP on which exemption under section 1010D does not apply and is issued on or after 1st Feb 2021 and aggregate premium for 2,50,000 aggregate premium exceeds 2,50,000 rupees in a previous year. We'll study this third condition in deal in afterwards. But till now, what we have studied definition of capital asset, it includes three assets. First of all the assets except for. Second thing is securities held by FIIs, and third ULIP on which exemption under section 1010D does not apply. I hope things are very much clear what capital asset means. So there are certain notes. Assets like TV, car, mobile, these are not capital assets. These are not capital assets because TV is movable and personal. Car is movable and personal. Mobile phone is movable and personal. Therefore, these are not capital asset. And any gain on arising of such any gain arising from transfer of such asset will not attract any capital gain. Any kind of jewelry, painting, these are capital asset because these are explicitly mentioned that these are capital asset. Car for business purpose. Sir, car for business purpose is not personal. Even though it is movable, but it is not personal, therefore it will be considered as capital asset. Utensils, if utensils are silver, these are considered as personal effect and no capital gain will be applicable. But if utensils are of gold, these are not considered as personal effect and capital gain will be applicable if they are sold. That's it. In the definition, we have come across a word called rural agricultural land. What is rural agricultural land? Provision says any kind of land which is not urban is rural. Any kind of land which is not urban is rural. So what is urban land? For that, you have to find out the municipal limit of an area. If an area has municipality or cantonment board, you have to find out limit to which the limits of municipality extends. you have to find out the limit of municipality and population. If population of that area is up to 10,000 rupees, then whatever the municipal limits are is urban area, and beyond that is rural area. If population of this area is exceeding 10,000 rupees, 10,000 people, but up to 1 lakh, then whatever the municipal limits are, that will be urban area. Plus 2 kilometers area surrounding to this urban area will also be considered as urban area. Got this point? If population exceeds 10, exceeds 1 lakh, but is up to 10 lakh people, then in that case, whatever the municipal limits will be urban area, and a 6 kilometer area beyond this municipal limit will also be considered as urban area. Last point, it says if population of an area exceeds 10 lakh people, then in that case, whatever the municipal limits are will be urban area, and an area comprising of 8 kilometers beyond this municipal limits will also be considered as urban area. So what we have studied, what is a rural area? Rural area is the area which is not urban area. And what is urban area? Municipal limits having population of 10,000 people. Municipal limits exceeding to 2 kilometers if population is exceeding 10,000 but up to 1 lakh. Municipal limits exceeding 6 kilometers if population is exceeding 1 lakh to 10 lakh. And municipal limit plus 8 kilometers of area if population exceeds 10 lakh people. And this area is to be seen from bird eye view. You don't have to see terrains or you don't have to see mountains in between. You just have to see bird eye view, whatever the distance as bird sees from flying, or drone view, whatever a drone sees, you have to see that distance. Did you get this point? What is rural agricultural land? Yes, sir, we did get this point. Section 247, what it says, transfer. What does transfer imply? Transfer imply any kind of sale of asset. If you sell any kind of your asset, if you sell any asset, if you exchange any asset for asset. For example, I gave my land to somebody and bought took gold from him. Third point, it says relinquishment of an asset. For example, I have an asset. If I gift it to you, this is relinquishment of an asset. If I gift that asset to you, that is relinquishment of an asset, and relinquishment will also amount to transfer. Fourth provision says any kind of extinguishment of any right. For example, if I have certain shares of a company and that company goes into liquidation, so my share capital will be reduced. I will be given assets against my share capital, and that will be extinguishment of rights in my shares in the company. My rights in the company will extinguish as company will go into liquidation. So extinguishment will also amount to transfer. Therefore, any kind of transfer, any kind of share capital taken away in case of liquidation will also amount to transfer. If I have a land which is compulsorily acquired by government, for example, if I have a land in nearby village and government announces railway wahi banega, government announces railway wahi banega, because of which government compulsorily acquired by land. In that case, compulsory acquisition will also amount to transfer. Conversion of capital asset into stock in trade. See, for example, if I have gold, my mother has been accumulated gold from many years. And now I just want to open a new gold shop, gold jewelry shop. For that matter, I converted my mother's gold into this stock in trade. This conversion will also amount to transfer. How capital gain will be calculated, we will study in later part. But you must remember that conversion of capital asset also amounts to transfer. Allowing possession of immovable property in part performance of a contract. For example, I have a friend in front of me called Neha. I just gave property to Neha and Neha gave me consideration. Property is yet not registered in her hands. Will it amount to transfer in my hand? Right answer is yes. If you give possession of any immovable property to somebody in part performance of a contract, even if you received consideration or not is not relevant. Even if registry has been done in her name is not relevant. If in part possession or part performance of the contract you have handed over the possession to somebody else, this will also amount to transfer. Any transaction which has an effect of enabling the enjoyment of immovable property shall also amount to transfer. For example, in cooperative societies, we do not have direct membership, direct ownership in the houses. In housing cooperative societies, we do not have direct access to the flats or the houses. In that case, society is the ultimate owner, and we are the deemed owner. We become owner on the basis of membership certificate of the society. In that case, even though we can transfer the property, but the property will not be transferred. We just have right of enjoying we just have right to enjoy that immovable property, and any kind of sale of such membership right will also amount to transfer. Last point says any kind of redemption in zero coupon bond will also amount to transfer. We all know zero coupon bond are issued at discount and redeemed at par. In that case, any kind of redemption gain that occurs in zero coupon bond will also amount to transfer and capital gain will be levied. So what I have said, any kind of sale, exchange, relinquishment, any kind of extinguishment, any kind of compulsory acquisition will amount, any kind of conversion of capital asset into stock it, any kind of any kind of handing over of immovable property in part performance of the contract, any transaction which has effect of enabling the enjoyment of an immovable property, and any kind of redemption of zero coupon bond will amount to transfer. This is the basic definition as per section 2 clause 47. Based on this definition, we have certain additional points which can be considered as transfer. First of all is capital asset destroyed in amount received from insurance company. For example, if I have a land, if I have a building and a fire caught in that building, in that case, building can be considered as transferred because my building is right, my right in the building is relinquished. Or that asset is extinguished, in that case, any kind of destruction will also amount to transfer. Therefore, any insurance received on that destruction will also amount to transfer and capital gain will be levied. If capital asset has been introduced by partnership firm to partner or partner to partnership firm will be transferred, we'll study that in detail. Third point, it says, sir, liquidation of a company. Sir, liquidation amounts to transfer. We have already studied liquidation amounts to transfer because there is extinguishment of a right in the shares of share capital of the company. I had certain rights in the company, but that rights are extinguished. Therefore, liquidation also amounts to transfer. Buyback also amounts to transfer. Slum sale also amounts to transfer. These all are in addition to what we have studied above. If this transfer takes place by disposing of any rights, by parting of any rights, or creation of any interest, this will also this will also amount to transfer, whether done directly or indirectly, conditionally, unconditionally, or whether by agreement or not, everything will be considered as transfer. For example, if I do not sell any property, but if I dispose of any property and I receive something in return, it will be considered as transfer. If I have two flats, if I have single flat, or I just part them into two parts and sell the second half, will it be considered as transfer? Yes, it will be considered as transfer because parting also amounts to transfer and creation of interest. If I have not sold any property, but I have given it to somebody on lease for 1,000 years, then also it will be considered as transfer. This is included in the definition of the transfer. I hope things are very much clear to you. Third is what are the type of capital asset? We have two kinds of capital asset. Remember this point. This is really very important for your examination because there is amendment in this point. We have two kind of capital assets. First of all is long-term capital asset. Second one is short-term capital asset. Any kind of capital gain arising from long-term capital asset will be long-term capital gain. Any gain arising from short-term capital asset will be short-term capital gain. You all know. But sir, how do we categorize a capital asset as long-term capital asset or short-term capital asset? We have to check for period of holding. How much time that asset is being held by you has to be checked upon. And what is the period of holding required to make them for long, make such assets long term or short term? We have period of holding concept. For different assets, we have different period of holding, and this period of holding has been changed with effect from 23rd July 2024. What was the scenario for the asset sold before 23rd July? Let us understand one by one. If any listed securities other than units of business trust on recognized stock exchange, if you sold any kind of listed securities other than units of business trust, you just need to check period of holding for 1 year. If held for more than 1 year, it will be long term. Otherwise, it will be short term. Units of equity oriented mutual funds. If you have any units of equity oriented mutual funds, you just have to check period of holding 1 year. It will be long term. Otherwise, it will be short term. Any kind of zero coupon bond, any kind of units of UTI, you just have to check period of holding for 1 year. If you hold them for 1 year, it will be long term. Otherwise, it will be short term. Second thing, any kind of unlisted shares. Unlisted shares that are not covered above. For example, if you have shares of Facebook, shares of Facebook are listed, but they are not listed on recognized stock exchange in India. Therefore, it will be considered as unlisted shares. Shares of Rahul Private Limited, sir, if you have to check period of holding of 2 years. Hold them for 2 years or more, it will be long term. Otherwise, it will be short term. Any kind of immovable property, it will be long term if you hold for 2 years or more. Otherwise, it will be short term. And last point is any other asset. For example, you have gold, you have debt oriented mutual fund, you have slum sale. So provision says any kind of such assets, if held for more than 3 years, it will be long term. Otherwise, they will be short. Did you get this point or not? Just repeat after me. Just repeat after me. The listed securities, other than units of business trust, equity-oriented mutual funds, zero coupon bonds, units of UTI. If held for more than 1 year, long term, otherwise short. Second thing. Unlisted shares, immovable property. If held for more than 2 years, long term, otherwise short term. Third, any other asset. If held for 3 years or more, long term, otherwise it will be short term. Do you remember this? Yes, sir, we do. We do remember this thing. This has been changed via Finance Act 2024 Part 2. What change has been proposed? Just read after me. Any kind of listed securities on recognized stock exchange. You have to check period of holding 1 year. Do you see a change? Earlier, business trust units was excluded from this listed securities, but now units of business trust are also included in this 1 year period of holding. Okay. Equity oriented mutual fund held for 1 year or more, zero coupon bond held for 1 year or more, or units of UTI. These all four assets you have to check for 1 year. Things are almost similar except for units of business trust, which were earlier checked for 3 years. Now they have to be checked for 1 year. Any other assets? Sir, now we do not have any concept of 3 year of period of holding. Every other asset other than these four will be checked for 2 years. Any kind of gold now, if you sell, will be checked for 2 years of period of holding. If you hold them for 2 years, it will be long term, otherwise it will be short term. And if you hold them for less than 2 years, then it will be considered as short term. Now, how question is to be solved? You just need to check the date of sale. For every question in capital gain, you have to check for date of sale, on what date you are selling such asset. Important point is, if you sell them for 23rd July 2024, you have to check for old period of holding. If you hold such asset as per these rules, then you have to find out whether it is long-term capital gain or short-term capital gain. But if you sold it, if you sell such asset after 23rd July, you have to check for newer period of holding. Just understand this point. For example, you bought gold on 24 or 1st April 2022, and you want to sell it on 22nd July 2024. Now, do tell, is it long term or short term? Right answer is, we have to check date of sale. If date of sale is before budget, then you have to check for old period of holding concept. For older provisions, we have to check for 3 years, because for gold we have to check 3 year of period of holding. Do we have we held such asset for 3 years? Right answer is no. Only 2.5 years we have held them. So this is short-term capital gain if I sold such assets on 22nd July 2024. But if I sold such assets on 24th July 2024, now we have to check for newer concepts. We have to check for newer provisions. And newer provision says there is no concept of 3 years of period of holding. We just have to check period of holding as 2 years. And have we held such gold for 2 years? Right answer is yes, because as per newer provisions, we have held such gold for 2 years or more. In this case, it will be long-term capital gain. So what matters is, we have to check the date of sale. And based on date of sale, we have to check, do we have to check older provisions or not? If we have to check older provisions, then period of holding as per older provisions will apply. If we have to check as per newer provisions, newer provision will apply. But this point, this is not complicated, but this is something new you need to remember. Now, major change, computation of capital gain. Section 48 prescribes computation of capital gain, how capital gain is computed. First of all, sir, very simple point. You just need to find out the sales consideration minus cost of acquisition. This is very simple. Will give you capital gain. Will give you capital gain. But this has been beautifully written in section 48. What it says, you just have to find out the full value of consideration at what price it is sold, asset is sold. Second thing, any kind of transfer expenses, any kind of expenses that are incurred with respect to transfer, but that should be directly attributable. For example, any kind of brokerage paid, any kind of commission. This reduction in transfer expenses will give you net consideration. You just have to reduce the cost of acquisition or index cost of acquisition from this net consideration, or cost of improvement or index cost of improvement from this index cost of improvement from this net consideration, and this will give you long-term capital gain or short-term capital gain depending upon period of holding. If you held such asset for uh, more than prescribed time limit, then it will be long-term, otherwise it will be short-term. This steps will give you capital gain for any kind of asset. You just have to follow these steps blindly. Now we just need to understand a few things for the purpose of calculation. First of all is, what is full value of consideration? This is the first matter of consideration. Second, what is cost of acquisition is second matter of consideration. Third is, what is indexation is the third matter of consideration. Let's start from third matter. What provision says? Second proviso to section 48 says, if we sell any kind of long-term capital asset, Then cost of acquisition has to be taken as index cost of acquisition. What is index cost of acquisition? Index cost of acquisition is nothing but whatever price that we have paid in the year of acquisition has to be indexed as per the current prices, as per the current index number. That is, we just have to divide by year or CII of year of acquisition, or CII of year of multiply by CII of year of transfer. This will index the cost of acquisition depending upon the inflation. This will index the price of the asset as per the inflation terms. So any long-term capital asset, if you sell, you just have to take cost of acquisition as index cost of acquisition. So we have index numbers right away starting from previous year 1 to from 100 to previous year 24-25 as 363. You need to remember this 363 for your examination, because for previous year 24-25, 363 is the index number. Got it, sir. Similarly, for improvement also, if you have done any improvement and capital asset is long-term capital asset, then any improvement will be, sir, index cost of improvement. For that, you just have to take improvement divided by CII of year of improvement multiplied by CII of year of transfer. In this case, to this you will get the index cost of acquisition and index cost of. Second thing, if what if asset is acquired before 1st April 2020, 2001? Because we have index number right away starting from previous year 1 2. But what if asset is acquired before that? What we have to do in that case? Provision says you have to take actual cost of acquisition or FMV as on 1st April 2001. Whatever the actual price was, you have to take first that, and or FMV as on 1st April 2001, whichever is higher will be considered as your cost of acquisition, and then you have to index it divided by 100 multiplied by CII of year of transfer. So specifically, there is a provision for immovable property. If we are selling any immovable property which is acquired before 1st April 2001, you have to check whether SDV, that is stamp duty value, available for that property or not. If stamp duty value is available for that property, then FMV cannot exceed stamp duty value. What this provision says. For example, if we bought house property for 10 lakh rupees in 1979 and FMV or as on 1st April 2001 is 1 crores and SDV on same date is 60 lakh rupees. Provision says if we have SDV available for as on the date of FMV, if we have SDV available as on 1st April 2001, then in that case FMV cannot exceed SDV. Therefore, FMV will be 60 lakh rupees only. So why this has been incorporated? Because people used to inflate their FMV, inflate their cost of acquisition, and to reduce their capital gain. Therefore, concept of SDV has been introduced, and provision says if SDV is available, then FMV cannot exceed. But what if SDV is not available? There are many backward areas for which SDV is not available. Provision says that whatever FMV derived will work. Whatever FMV derived will work. Remember one point. If we have any cost of improvement done before 1st April 2001, will be completely ignored because that has already been considered in this FMV now. If any improvement is done before 1st April 2001, then it will be ignored because it is already considered in FMV. This is all about the indexation provision. You all know this. But one thing has changed. With effect from 23rd July 2024, indexation concept has been scrapped. Earlier, you used to get indexation on almost all the assets except for a few. You were not allowed indexation on listed securities. You were not allowed indexation on any securities in which FI and NRI invest. Or you were not allowed indexation in case of slum sale. You were not allowed indexation in case of market linked debentures. These were the cases you were not allowed indexation. But in rest all the securities, you were allowed indexation. Provision says with effect from 23rd July 2024, indexation concept has been scrapped. If you sell any asset after 23rd July 2024, there will be no indexation, even if capital asset is long-term capital asset. There will be no indexation whatsoever. There will be no indexation whatsoever. So this is a disadvantage to us. Right answer is this is not actual disadvantage, but there has been certain changes in tax rates. Earlier tax rate was 20% with indexation, but now tax rate has been changed to 12.5% and indexation has been scrapped. Therefore, there is no actual loss in this, but there are certain losses which we will discuss later on. Got it, sir? This indexation provision is only applicable for assets transferred before 23rd July 2024. If assets are transferred before 23rd July 2024, then you have to consider index cost of acquisition. If they are transferred after 23rd July, then in that case, you don't need to index any cost of acquisition. Whatever cost of acquisition that you have found out will be the ultimate cost of acquisition. You don't have to index it at all. Got this, sir? Yes, sir. We did get this point. We'll study this point later on. We'll study this point later on. No need to worry. First proviso to section 48. What this proviso says. For example, if any non-resident invests in India. For example, if any non-resident invests any securities in India, what happens is, just understand this with an example. We have named Mr. Joey Tribbiani. Joey Tribbiani in previous year 2005 brought $1 lakh in India, and at that time rate was 50 rupees. $1 amounted to 50 rupees. He invested in Reliance. He invested 50 lakh rupees in Reliance. Not Reliance, but he invested 50 lakh rupees in Rahul Private Limited. Rahul Private Limited. What happened with years and years of passing? This shares of Rahul Private Limited grew, and his investment of 50 lakh rupees turned 70 lakh rupees. In previous year 2024, he intended to sell such assets. He intended to sell such shares of Rahul Private Limited. What happened is he sold such assets. And in India, Mrs. Nirmala Sitaraman ji asked for capital gain. Sales consideration was 70 lakh rupees. Cost of acquisition was 50 lakh rupees. Capital gain will be 20 lakh rupees. This is something Nirmala Sitaraman ji asked from this Ajoy Tribbiani. Now what happened is he paid the taxes. He paid the taxes. Now when he took the money of 70 lakh rupees and went for conversion, what happened is, when he converted such 70 lakh rupees, now exchange rate has changed. Exchange rate has increased. Now $1 amounts to 70 rupees. In that case, he is taking back $1 lakh only. 1 lakh rupees only. Now, if you see in substance, he brought 1 lakh rupees, $1 lakh, and he took $1 lakh. He has not got any advantage. He has not got any advantage. His effective gain is zero, because every gain that he has got from the company has been nullified in decrease in exchange rate. Therefore, effectively, he has not got any benefit. Therefore, taxing this 20 lakh rupees will be a loss to him now. This will be wrong with him. Therefore, for that matter, a proviso has been inserted under section 48. This provision, the first proviso says, if any non-resident invests in any securities in Indian market, then any capital gain arising shall be computed in foreign currency. Therefore, in this case, any capital gain arising in the hands of Joey Tribbiani will be calculated in foreign currency. How it will be considered? You have to find out the capital gain first of all. Full value of consideration 70 lakh. Cost of acquisition 50 lakh. Now this full value of consideration has to be converted in foreign currency. What will be the exchange rate? Provision says full value of consideration will be taken average of buying and selling rate on the date of transfer. You have to take the average rate, average foreign exchange rate of buying and selling rate on the date of transfer. Whatever the buying rate is, whatever the selling rate is on the date of transfer, you just average it out and convert it. For example, 70 is the average rate, so it will be $100, one lakh dollar. For cost of acquisition, you have to take average of buying and selling rate on the acquisition date. So whatever the average of buying and selling is, you just have to take on the date of acquisition. And let us suppose capital gain is of $1,000. Provision says capital gain converted it into India, then it will be calculated. It will be converted via buying rate on the date of transfer. Whatever the date of transfer is, you just need to convert this capital gain as per exchange rate as on the date of the transfer. And you just have to take buying rate. Got this, sir? Yes, sir. One condition has to be fulfilled, then only non-resident can avail exemption under this benefit under this section. Is non-resident should be SSC should be non-resident in the year of transfer. Yes, sir, got this. And sir, indexation is not available where first proviso is applicable. Even though after budget, after 23rd July, indexation is not available for any asset. But if assets are sold before this 23rd July, then also indexation will not be applicable for any non-resident availing benefit in this section. Did you get this point or not? Are Baba, did you get this point or not? Yes, sir, we did get this point. This was all about second proviso. This was all about the first proviso under section 48. Second proviso is all about indexation. Any capital asset, any long-term capital asset will be considered as index. Will be calculated via index cost of acquisition. What third proviso says? First and second proviso is not applicable for competition of LTCG under section 112. If you sold any kind of listed securities, listed equity shares, equity oriented mutual funds, or any kind of units of business trust, then in these cases you will not get indexation benefit, or any non-resident will not get his capital gain calculated in foreign currency. His capital gain will be calculated in Indian currency only. So first and second proviso is not applicable for listed securities. Fourth proviso, no indexation is available for bond and debentures, sir, except capital index bond and sovereign gold bond. After 23rd July, even though no indexation is available for every asset, no indexation is available. But before 23rd July, also bonds and debentures were not allowed indexation. Bonds and debentures were not allowed indexation, but sovereign gold bonds and capital index bonds were allowed indexation. What are the details? We'll study about that later. But you just need to remember, after budget, no assets are allowed indexation. Before budget, also bonds and debentures were not allowed indexation, but only sovereign gold bonds and capital index bonds were allowed indexation. What fifth proviso? Fifth proviso says any kind of forex fluctuations in case of RDB shall be ignored in case of non-resident at the time of redemption of such RDB. Any kind of foreign exchange fluctuations on account of RDB shall be ignored. Similarly, similar to first proviso, you just need to ignore this point. Sixth proviso says if a company offers any kind of ESOPs to its shareholders, ESOPs to its employees, then whatever the FMV on the date of exercise, on the date of exercise will be considered as cost of acquisition for employee. What this provision says, for example, if a company named Reliance gives ESOPs to Rahul, and for example, share price of Reliance is 1500 rupees, and this ESOPs are given at a cost of 900. Then Rahul is being given benefit of 600 rupees. What will be cost of acquisition for Rahul? Provision says cost of acquisition for Rahul will not be 900 rupees. It will be 1500 rupees because that is the FMB. Why, sir? Why FMB? Because this difference of 600 rupees is taxable under that salary for Mr. Rahul. This we have studied in CA intermediate only. Whatever the benefit that employee gets on account of getting ESOPs, that benefit is nothing but taxable under his salary. Therefore, whatever the FMV is will be considered as cost of acquisition for Mr. Rahul. Did you get this point or not? Yes, sir. Yes, sir. We did get this point. This provision says FMV on the date of allotment of the ESOP shall be considered as FEOC for the company and cost of acquisition for the employee. That means for Rahul, cost of acquisition will not be amount of price paid to the company. It will be the FMV as on the date of allotment. Seventh proviso says any kind of STT. STT is security transaction tax. Whenever you buy or sell any kind of securities that are listed on recognized stock exchange, you are mandatorily required to pay STT on such transactions. Even you are required to pay STT on purchase transaction and also on sale transaction. Provision says such STT paid will never be considered while capital gain calculation. You can neither reduce your selling price from you cannot reduce STT from selling price. You cannot take deduction of STT under transfer expenses, nor you can add such STT in your cost of acquisition. You will not consider such STT in any case, this provision says under 7th proviso. Yes, sir, we did get this point. These were certain provisos that you must remember while calculating the questions of capital gain. Now we need to talk about full value consideration. What does full value consideration imply? Full value consideration imply any kind of money that you receive on account of sale of such asset. Any kind of money that you receive or accrue to receive on account of sale of asset. Whatever money, whatever the sales price that we are getting is nothing but full value consideration. What if, sir, we give such asset for free or we just exchange the asset? Then in that case, whatever the asset you receive, you have to take FMV of such assets. But this is the simple layman definition for full value consideration, but there are certain special cases for calculating full value consideration. First special case is prescribed under section 50C. If you sell any kind of immovable property, there are greater chances that your sales price will be manipulated. You will try to sell it as low as possible to reduce your capital gain. You will try to sell it as low as possible, and you will try to include more and more black money component in that. Therefore, in that case, what happens is, in case of immovable property, SDV plays an important role in determining full value consideration. You have to check whether stamp duty value exceeds 110% of consideration. Then in that case, what happens is your stamp duty value will only considered as full value of consideration. What this provision implies, if stamp duty value exceeds 110% of consideration, that means your stamp duty value is this much and you are selling it at a very lower price, then provision says this sales consideration is illegitimate. The sales consideration is wrong. This is merely a sham. Your actual SDV will amount to full value of consideration. But if SDV is lesser than 110% of consideration, that means your SDV is this much. Your consideration is this much. That means your consideration is legitimate now. Therefore, in that case, whatever the consideration paid is will be considered as full value of consideration. Let us understand this with an example. For example, stamp duty value is 11 lakh 20,000 rupees. An asset is sold for 10 lakh rupees. What provision says stamp duty value should we have to check for 110% of consideration. SDV is 11 lakh 20,000 rupees. 110% of consideration is 11 lakh rupees. SDV exceeds 110% of consideration. Therefore, in this case, stamp duty value will be considered as full value of consideration. What if, sir, we are not satisfied with SDV? That house that I'm trying to sell is very haunted house. I'm not able to sell that house at such SDV. What happens is provision says if you are not satisfied with the SDV of a property, you can ask assessing officer to refer this case to valuation officer. Valuation officer will thereafter determine the SDV of that property. For example, earlier determined SDV was 50 lakh rupees. Now valuation officer did go to house and found out that this house is really haunted. This house is really haunted and there is a woman named Manjulika roaming around the house. Her feet are crossed. She is wearing a white sari. She is wearing certain kinds of mala on her neck. This house is really haunted and SDV should not be 50 lakh. It should be 25 lakh. That means SDV determined by valuation officer is below the original SDV. Then what SDV you will consider? Whatever the SDV is determined by valuation officer, you will consider that only now. But, but, he did go to house. He did go to house to find out the SDV. Earlier SDV was 750 lakh rupees. He went to house and he found out that there is a beautiful woman in that house. Beautiful women. And this house is worth much more than 50 lakh rupees. He found out that SDV is 80 lakh rupees. Then in that case, which SDV you will take for your full value of consideration? Provision says if valuation officer increases SDV, then take the original one. Then take the original one. And what provision I have said is nothing. But in case valuation officer reduces the SDV, take the newer SDV. If valuation officer increases the SDV, take the original one. That is the bottom line. Sir, what SDV we will take? SDV on the date of agreement or registration. For example, I made an agreement to sell today. And agree sale will be done after 10 months. What SDV I will take? Today's or after 10 months? Provision says you have to check whether the other party gave you consideration any rupee, gave any consideration via account pay check, account pay demand draft, or electronic clearing system. Provision says if any of the consideration is received on the date of agreement, then SDV on the date of agreement will be considered. But if no money has been received on the date of agreement, then SDV on the date of registration will be taken. And money must be received via account pay check, account pay demand draft, electronic clearing system. If any money is received on the date of agreement, then SDV on the date of agreement will be taken. Otherwise, SDV on the registration date will be taken. Section 50C. Sales consideration in case of unquoted shares. Whenever you sell any kind of unquoted shares, then what will be the full value of consideration? Because many a times the unquoted shares fair market value is not real. Fair market value is not known. So people tend to sell it at a very lower cost. In that case, how you will determine the full value of consideration? Provision says you have to check the sales price or fair market value, whichever is higher. You have to check for fair market value or sales consideration, whichever is higher. You must remember that this provision is not applicable to the companies whose board of directors are suspended by central government. If central government under section 242 of Companies Act suspends the board of directors of a company, then this section 50 CA provision are not applicable. That means if a company whose board of director has been suspended by central government and you try to sell shares of that company, in that case FMV or sales price whichever is lower is not applicable. Only sales price is applicable. Section 50D. For example, we have a student named Pooja. We have a student named Pooja, and she was just playing with the paints. She drew a donkey. She drew a donkey. Again, she drew another donkey on this donkey. Oh my god. She drew a boy named somebody, Mr. X, and she drew India on that person and named this painting as Assassination. ass, another ass person on that, and whole nation on that person is assassination. He drew a painting, beautiful painting. People have gone crazy just to view this painting. People are paying thousand rupees of tickets just to view this painting of painting assassination. Just after Mona Lisa, this painting of assassination is viral. Now, if Pooja wants to sell this painting, what will be the full value consideration? Provision says FMV on the date of transfer of this painting will be considered as full value of consideration. This is as per section 50. This is how we'll calculate the full value consideration. Now, let us find out how to calculate the cost of acquisition. Section 55 talks about how cost of acquisition for any kind of capital asset is calculated. In normal cases, sir, in normal cases, how cost of acquisition is calculated? Whatever price you are paying now, whatever price you are paying to buy such asset is cost of acquisition. That is only the cost of acquisition. Yes, sir, that is true. But remember, do not include STT, security transaction tax, in cost of acquisition. Second thing, any amount paid to obtain the clear title on the property. If you are paying any sum to obtain the clear title in the property, for example, my father bought any kind of property and he took it on loan and couldn't pay the loan. Now I have to pay the penalty amount on that loan because he couldn't pay, so I have to pay the penalty now. So in that case, whatever penalty I am paying for obtaining the clear title of the property, provision says this will be also considered as cost of acquisition. Third provision is important. What it says, if you are acquiring any property via loan and you are paying interest on that loan also, people used to what people used to do is, whenever they used to pay interest on that loan, they used to get that reduced in cost of improvement. People used to reduce that interest paid as cost of improvement in the house property. People used to do that. It is general parlance. People do it. Provision says do it, no issue. But if you have taken interest or principal as deduction under section 24B, remember 24B house property 2 lakh interest allowed, let out house property interest allowed. If you have already taken deduction of such interest under section 24B, or you have taken deduction under section 80 double E, double EA, or double E, or you have taken principal deduction under section 80C, then in these cases, whatever the deduction that you have taken in other section will not be allowed as cost of acquisition. You cannot take such deduction already claimed as cost of acquisition. Any remaining amount will be considered as cost of acquisition or improvement. Got it, sir? Got it? Yes, sir. Clear. Special cases. How capital gain, how cost of acquisition will be considered in special cases. First of all, whenever you receive any asset which is not regarded as transfer. Any asset received on account of transaction which is not regarded as transfer. For example, I received a gift from my sister. She gave me her house property. She gave me her house property. Now, if what if I sell such house property? Capital gain will arise in my hand. Provision says what will be my cost of acquisition? My cost of acquisition is normally nil because I have not paid any money to acquire house property. But provision says since you have acquired such house property on account of exempt transfer, then whatever cost of acquisition is just before such transfer will be considered as cost of acquisition. That means whatever cost of acquisition is, cost of acquisition of my sister will be considered. What I'm saying is just understand this point. For example, my sister Soumya bought a house property at rupees 10 lakh rupees. He gifted me such property and I sold it. He gifted such property to Rahul and I sold this property for 100 lakh rupees. Provision says capital gain will be applicable in my hands because ultimately I am selling. So full value of consideration will be 100 lakh rupees. Less cost of acquisition will be nil because I have not received now. But provision says if you have received any property on account of exempt transfer, then cost of acquisition of the previous owner shall be considered. So in that case, cost of acquisition will be 10 lakh. That is cost of acquisition of the previous owner. If you if you have any kind of goodwill, trademark, brand name for business or profession, if you have right to manufacture, produce, process any article or thing, for example, if you have patent or copyright, if you have any kind of right to carry on any business and profession, okay, no problem. If you have any tenancy rights, loom hours, route permits, or any other right, in short, if you have any kind of intangible asset. If such intangible asset is self-generated, then take cost of acquisition as nil because you have not paid any money now. It will be nil on. But if such intangible asset is acquired, then whatever purchase price you have paid will be taken as cost of equity. If you have acquired any goodwill, take cost of acquisition. If you have acquired any copyright, take it as cost of acquisition. If you have acquired any kind of patent, then take such patent. Then purchase price, whatever price that you have paid, will be considered as cost of acquisition. Remember, FMV benefit as on 1st April 2001 is not applicable for such intangible assets, because you'll never be able to identify FMV as on 1st April. Now, how you will be able to identify? Third provision says, if depreciation is claimed by the assessee, then cost of acquisition will be purchase price minus depreciation. If you have claimed any depreciation on these intangible assets, then purchase price will be cost of acquisition minus depreciation reduced. Similarly, for other depreciable asset, what the cost of acquisition is? WDV available, WDV of the asset. Or if any asset is acquired before 1st April 2001, then FMV as on 1st April 2001 is also applicable. No issue whatsoever. How cost of acquisition is considered for bonus shares? What it says. If any bonus securities are being allotted before 1st April 2001, 1st April 2001, before 1st April 2001, if any bonus is allotted, then fair market value as on 1st April 2001 will be considered as cost of acquisition. If allotted later on, then cost of acquisition will be nil, because I have got those shares for free now. So no issue whatsoever. Provision says, if such securities are listed securities, or those securities are falling under 112A, in that case, cost of acquisition such bonus shares shall be FMV as on 31st January 2018. That is the grandfathering value that we used to do, will be considered as cost of acquisition for such bonus securities. I am saying before 1st April 2001, take FMV as on 1st April. If a bonus is being allotted thereafter, then in that case you have to check whether securities fall under 112A. In that case, you can take FMV as on 31st January 2018. Otherwise, cost of acquisition will be completely nil. How cost of acquisition is considered in case of right shares? If right share is nothing but I get a right to buy shares at a discounted value. For example, if share is trading at rupees 100, so I get a right to buy it at 70 rupees. Then in that case, what can I do? I can either exercise my right. I can buy the shares at 70. Then what will be my cost of acquisition? My cost of acquisition will be 70. I can renounce this right. I can sell this right to somebody else. For example, if I don't want to buy this share at 70 rupees, I just want to sell this right to somebody. I can renounce this right. For example, at rupees 10, I am renounce this right in the name of person in the favor of person named Ishan. I'm renouncing this right in name of Ishan. Now, in that case, what will happen? This 10 rupees will be considered as short-term capital gain in my hands, because I'm getting money for free now. I'm getting money for free. What will happen? Ishan, you need to understand. For Ishan, he's paying 10 rupees to me, and he is paying 70 rupees to company. So for Ishan, cost of acquisition will turn out to be 80 rupees. What happens is, if I exercise right, then whatever price I am paying to the company will be cost of acquisition. If I'm renouncing such right, then whatever money I am receiving as renouncement will be short-term capital gain. And for the person who is acquiring such renounced right, in that case, his cost of acquisition will be amount paid to company, and amount paid for renunciation will be cost of acquisition. Sweat equity shares, cost of acquisition will be FME. So, for example, if I am an employee of Reliance and I am being offered shares worth rupees 1500 at rupees 900, then in that case, what will be my cost of acquisition? It will be not 900. It will not be 900. It will be 1500 only. Whatever the actual FMV on the date of allotment is, will be cost of acquisition. In case of demerger, what it says, for example, we have a company named Reliance which has 1,000 crore of shares, 1,000 crores of shares, 1,000 crores of net assets. Out of this Reliance, Geo Financial Services is being demerged, and 100 crore assets are being transferred to Geo Financial Services. What this provision says, let us suppose Reliance share price is 1500 rupees and net assets are 1,000 crores. Out of this 1,000 crores net assets, 10 crores are being transferred. So can I simply say Geo share price will be 150? Because one tenth of the assets are transferred, so one tenth of the share price will be the share price of Geo Financial Services. That is only that is only the share. That is only the value of shares issued in case of demerger. Shares issued in case of demerger. For example, in case of the demerger of Reliance, I get shares of Geo Financial Services. So, what will be cost of acquisition of Geo Financial Services? You just need to take out the shares in case of cost of shares of demerged company. For example, Reliance share price is 1500. Net book value of asset transferred is nothing but 100 crore. Net book value of the demerged company before demerger was 1000. Therefore, cost of acquisition for Geo Financial Services is 150 only. Whatever the net assets are being taken, in that proportion you have to take the share price of the resulting company. That is the bottom line. This is how you have to calculate the cap. What we have studied till now is, first of all, definition of capital asset, then transfer, then period of holding concept. And after that, we came to capital gain portion. How capital gain is calculated? In that case, in that we have studied the provisos. We came across the provisos. Then we came on to sales consideration portion and then cost of acquisition portion. Let us come to special cases on how to calculate capital gain in special cases. We have special cases in two parts. First is exception to section 45. What this says is section 45 says any gain arising from transfer of capital asset shall be taxable under that capital gain in the year in which transfer took place. Gain arising from capital asset shall be taxable under that capital gain in the year in which transfer took. What if the transfer takes place in another year? Will that capital gain be always taxable in that previous year? Right answer is no, it is not necessary. There are four exceptions to this point in which transfer takes place in certain other year and capital gain is taxable in the other year. How is it possible? Just understand this point. First of all, is capital asset destroyed. For example, if I have a house property holding since 1/4/2001, and since house property is destroyed in previous year 1819. Now, since asset is being destroyed, destruction of house property amounts to transfer. So property is transferred in previous year 1819 only. In that case, capital gain will not rise and taxing capital gain will not be legitimate point. Because I have not received any money now. I have not received any money. So how capital gain should be arising in my hands? Provision says capital gain will not arise in the year of transfer. Capital gain will arise in the year in which you receive the insurance money. In the year in which you receive the insurance money, you will be charged capital gain. Therefore, this is exception to section 45(1), which says capital gain shall be taxable in the year of transfer. But in this case, capital gain is not taxable in the year of transfer, it is taxable in some other year. What this provision says, as per section 45(1), capital gain is chargeable to tax in the year of transfer. But in the following cases, capital gain is not taxable in the year of transfer. In following cases, it is not taxable in the year of transfer. For example, section 45(1)(a). Insurance received on account of damage or destruction of the capital asset. Capital asset destroyed due to fire, earthquake, tsunami, riot, civil disturbance, enemy action, insurance received, then capital gain is applicable. The year in which the year in which capital gain is destroyed is less relevant, but the year in which insurance money is received is more relevant for computation of capital gain. How capital gain will be calculated? Full value of consideration will be nothing but sir, insurance money that is being received. Or if you do not receive any insurance money, you just receive the new asset, then whatever the asset FMV is will be full value of consideration. Minus cost of acquisition. Sir, cost of acquisition will be taken. Sir, if capital asset is long-term capital asset, then cost of acquisition will be indexed if transfer is before budget. Cost of acquisition will be indexed. Yes, sir, cost of acquisition will be indexed. Provision says, what provision says? Till when you will index? If asset was acquired in previous year 1, 2, it has been transferred in 1819 and you receive compensation in 24/25. Till what year you will index? 1819 or 24/25? Right answer is till the year of transfer you have to index. So you have to index from previous year 1, 2 to 1819. You just need to remember this point. But it's a capital gain will be taxable in the year of receipt of insurance claim. Very important, very simple point, not difficult as such. Section 45(1), what it says: conversion of capital asset into stock in trade. For example, if I have a piece of land bought in previous year 1617, in previous year 2021, I decided to convert such land into stock in trade. I just decided to develop a colony, build many houses, and sell such houses one by one. Provision says since conversion amounts to transfer. We have studied this in definition of transfer that any kind of conversion of capital asset into stock in trade amounts to transfer. Therefore, capital gain should be applicable in my hands in the year in which transfer took place. But this falls under the exception and says capital gain will not be taxable in the year of conversion. Rather, it will be taxable in the year in which such stock in trade is. Got this point? Yes, sir, we did get this point. How capital gain will be calculated? Sir, capital gain will be calculated. First of all, we need to find out the full value of consideration. Full value of consideration will be nothing but fair market value on the date of conversion. Whatever the fair market value on the conversion date is, you just need to find out and you just need to take it as FVOC. You just need to find out the fair market value and take it as full value of consideration. Reduce cost of acquisition. Yes, sir, cost of acquisition. This cost of acquisition will be taken as index cost of acquisition. If such property is sold before budget, then you can take index cost of acquisition. And indexation will be done from acquisition till the date of transfer and not till the date of actual sale. But you have to index the cost till the date of transfer. If improvement is done, then improvement will be indexed till this period, and period of holding for the purpose of determining will be considered from the acquisition date till the transfer date. This will be considered as period of holding for determining whether it is long-term capital gain or short-term capital gain. So, for example, if I have a land of rupees 10 lakh, FMV on conversion is 100 lakh. So capital gain, let us assume 100 divided by cost of acquisition. Cost of acquisition 100, after indexation it is 30. Then capital gain, long-term capital gain is 70. Let us assume this. Reasonably, we can assume this. Now, if such FMV, if such property is partially sold, partly sold, that is 50% is sold at rupees 80 lakh, at 80 lakh. Then we'll have PGBP income. We'll have PGBP income as 80 lakh is revenue minus cost of acquisition is 50 lakh. PGBP will turn out to be 30 lakh rupees. As we sold such stock in trade, we'll have PGBP income in our hands. In that case, what will happen? 30 lakh will be taxable as PGBP. What my point is, that if proportionate stock in trade is sold now, then proportionate capital gain will only be taxable. In this case, since 50% of the stock in trade is sold now, then in that case, in the previous year in which such stock in trade is sold, only that proportionate capital gain will only be taxable. For example, out of the 70 lakh, only 50% will be taxable in the year in which such stock in trade is sold, because only proportionate amount has to be taxable because proportionate stock in trade is sold now. If I sell even a single flat, then in that case, full capital gain will be taxable. This will be wrong now. This will be wrong now. So for that matter, whenever we sell such stock in trade, then only proportionate capital gain corresponding to such stock in trade will be taxable in the hands of the assessor. Also, remember, so do you remember Section 54EC? If you sell any kind of immovable property, you are allowed an exemption under Section 54EC. If you buy bonds of NHAI, RECL, PFCL, IRFCL, you can claim exemption up to 50 lakh rupees. For that matter, if you remember, we were required to buy assets within 6 months from the date of the transfer. We are required to buy the assets within 6 months from the date of the transfer. But in this case, what happens is we have already transferred assets 4 or 5 years ago, 6 years ago. We have already transferred such stock in trade, capital asset into stock in trade in previous year 2021. In this case, how can I invest money in within 6 months from the date of transfer? How can I invest money within 6 months from the date of the transfer? Provision says need not to worry. Provision says they need not to worry. Do not invest money from the date of transfer. Invest money from the date on which such stock in trade is sold. You just need to invest money from the date on which such stock in trade is sold. Third point, compulsory acquisition under any law. What this point says is, if I already have any property, and such property has been compulsory acquired by government or any other person, but it has been lawfully compulsorily acquired, then in that case, capital gain will arise in my hand. But capital gain will arise in the year in which such property is compulsorily acquired, but it will be taxed in the year in which I receive the compensation. It is reasonable now, because taxing in the year in which compulsorily acquired is not legitimate. I have not received any compensation. I may or may not receive. I may receive deficit compensation. In that case, it is logical enough to tax such capital gain in the year in which compensation is received. Therefore, in this case, capital gain is not charged in the year of transfer. Rather, capital gain is charged in the year in which compensation is received. Now we do have a two kind of compensation. First of all is initial compensation and second is enhanced compensation. Initial compensation is the first compensation that has been awarded by the government. Like whenever government compulsorily acquires any property, it says 5 lakh compensation, 10 lakh compensation, 1 crore compensation. This is nothing but initial compensation. What if I am not satisfied with this compensation? I can move to court. I can go to court and ask for more compensation. Then whatever compensation that court rewards will be enhanced compensation. How taxability is? The provision says whenever out of this initial compensation, first installment, for example, court awards compensation of 5 CR, and out of that first CR is received 2 CR, 1 CR, and 1 CR. I received this 5 crore rupees in 4 installments. Provision says whenever this first installment is received, then whole 5 crore will be considered as full value of consideration. In the year in which first compensation is received, then whole capital gain will be taxable. Full value of consideration will be 5 crore. Whatever the cost of acquisition is, you have to reduce that. If such capital asset is long-term capital asset, then index such cost of acquisition. If you have done any improvement, then reduce cost of improvement or index cost of improvement, and long-term capital gain, short-term capital gain, depending upon period of transfer or period of holding From acquisition till the date of compulsory acquisition, you have to check. But I've said for the purpose of initial compensation, you just need to find out the you just need to take the entire initial compensation when first installment is received. Indexation is to be done up to the date of compulsory acquisition. Period of holding has to be determined from the date of acquisition till the date of compulsory acquisition. That is the bottom line. What about enhanced compensation? Provision says if you receive any enhanced compensation, it will be taxable as and when received. Enhanced compensation will not be taxable in the year in which you assume to be received. It will be taxable in the year in which it is actually received. How capital gain will be calculated? Provision says find out the amount of enhanced compensation, reduce any litigation expenses, and find out long-term capital gain, short-term capital gain. How long-term, short-term? Provision says whatever will be the nature of initial compensation. If it is long-term, then enhanced compensation will be long-term. If it is short-term, then enhanced compensation will be short-term. This is how enhanced compensation will be. Capital gain or enhanced compensation will be computed. Now there is another point. Provision says if you receive any kind of enhanced compensation due to interim order of the court, you receive enhanced compensation due to any interim order of the court, then enhanced compensation will not be taxable unless you receive a final order, and it will be taxable in the year of final order. What did I just say? Initial compensation received, any installment received will be taxable in full. Enhanced compensation, if received due to interim order, will not be taxable. If received due to final order, taxable whenever received. That is the bottom line. Sir, how interim order, how final order? For example, my property is being acquired. Government announces 5 crore compensation. That is initial. But I'm not satisfied. I want 15 crore compensation. I want 15 crore compensation. So for that, for additional 10 crore compensation, I moved it to court. The court also knows that this property is worth way more than 5 crore. For that, court just said just give 5 crore as initial as our interim order, then remaining 5 crore we will give as final order is passed. Court ordered the government just pay 5 crore rupees as our interim order, and then remaining amount you can pay when final order is passed. So if any enhanced compensation is received on account of interim order of any court, then in that case it will not be taxable unless final order is passed, and whenever final order is passed, then whole enhanced compensation will be considered for the purpose of capital gain computation. Now whenever any kind of compensation is being received, there is possibility that government may delay such payment. Then in that case government has to pay interest on such delayed compensation. That interest is taxable under that income from other sources. That interest is taxable under the income from other sources, and provision says nothing but this interest shall be taxable after considering 50% standard deduction under section 57. Provision says whatever interest you received on account of compensation from compulsory acquisition, then you can get 50% standard deduction on this interest amount. Interest on lane compensation shall be taxable under the year of receipt. It will be taxable in the year of receipt, not in the year of accrual. And 50% of deduction shall be allowed on such interest under section 57. Sir, what if, sir, court reduces any kind of compensation? For example, initial compensation was 5 crore. Later on, court reduced this compensation to 2 crore. What will happen? Now, in that case, AO will file the rectification, AO will give the rectification, and that effect will be given to the given same. So what happens is, for example, if there is any immovable property used by individual or HUF, and has been it is not nothing but immovable property but urban agriculture land. It is used by individual HUF for at least 2 years, and this has been compulsorily acquired by government, and RBI paid the compensation under section 1037 is exempt. Immovable property, urban agriculture land as immovable property held by individual HUF for 2 years or more. In that case, if it is compulsorily acquired and RBI pays compensation, then it is exempt under section 1037. What if my property is compulsorily acquired and I just went to collector for further negotiations to increase the price of that property? Will it amount to voluntary sale? No, sir, it will be compulsory acquisition only. If I just want to get my compensation enhanced, that does not mean I want to sell that property. That is still compulsorily acquired. It does not amount to any sale. Provision says if compulsory acquisition, SSC moved to collector for further negotiations instead of court to enhance the compensation, it shall not change the character of the acquisition from compulsory acquisition to voluntary sales. Hence, exemptions shall still be allowed. Provision says, if for example, compensation is received under Section 96 of Right to Fair Compensation, Land Acquisition, Rehabilitation, and Resettlement Act 1996, it will be exempt. You don't need to remember this act. You just need to remember any kind of act right to fair compensation and received compensation under Section 96 of such act. What provision says? Sir, for example, my property is compulsorily acquired. I received the initial compensation, and such I have also paid taxes on such initial compensation. Later on, I died, and my legal hire or any of my SSC who is taking care of my assets later on receives such enhanced compensation. Enhanced compensation will be taxable in his hands, not in my hands. Of course, a person died, how things will be taxable in his hand? It will be taxable in his legal hires. In case of death of the transferor, enhanced compensation is received by any other person, then it will be taxable in the hands of such other person. This is in case of compulsory acquisition of any property. Third exception to Section 45(1). Fourth exception, if any property is transferred under joint development agreement. What this provision says. In case of individual HF, important point to note, this is a point worth noting that joint development agreement is only applicable to individual and HF. If a land, building or both is transferred under joint development agreement, then capital gain shall be taxable in the year in which completion certificate is received by the competent authority. What this point says, if I have any kind of immovable property, land or building, I transfer such property to any kind of developer under joint development agreement. What is joint development agreement? It says I am giving you land, you construct properties on such land, in consideration pay me certain money and give me certain flats of such property, less remaining you can sell yourself. This is nothing but joint development agreement. Now, in this case, whenever I am transferring my property, since I am handing over my possession to such developer now, so in that case, it will amount to transfer. Capital gain shall be applicable. Provision says yes, capital gain should be applicable, but it will not be taxable in the year in which you are transferring the property. It will be taxable in the year in which that developer is receiving the completion certificate. For example, Rahul has 1 acre of land worth rupees 5 crore. He gave such properties to Lodha developers, and Lodha developers will develop such property on land, and against which Rahul received 10 flats worth rupees 50 lakh each plus 1 crore cash consideration. He gave worth rupees 5 crore land and received 6 crores. How capital gain will be calculated in the hands of Rahul? Sir, for the purpose of capital gain computation, take SDV on the date of the completion certificate. That means Rahul received 50 lakh or 50 flats of 10 lakh, that is 500 lakh he received, plus 1 crore cash, that is 100 lakh rupees cash, that means he received the 6 crore rupees. Cost of acquisition was 5 crore, capital gain will be 1 crore. Long term, short term, depending upon period of holding. What if, sir? What if I handed over the property to Lodha developer on 1st April 2019? Completion certificate is yet to be received or yet to be received on 1st April 2025. Completion certificate is yet to be received, but I'm in a need of money and I have just sold my right to receive such property on 1st April 2024. That means Rahul transferred such property before receiving the completion certificate. In this case, provision says this exemption is not applicable. This exemption is not applicable, and Rahul will be taxed in the year in which he actually transferred the property. That means if property is transferred by Rahul before completion certificate, then this provision is not applicable. That means in that case, capital gain will arise in the hands of the Rahul in the year in which he actually transferred the property. How will that be given effect to? Provision says AO will file the rectification for that year. What will be the cost of acquisition of the amount received in joint development agreement? Provision says, for example, Rahul received 10 flats of 50 lakh each, plus 1 crore he received. Now, what if he intends to sell one flat at rupees 90 lakh rupees? What will be his cost of acquisition? Sir, can I consider his cost of acquisition as 50 lakh rupees, or should I consider 6 crores divided by 10, that is 60 lakh rupees? What will be the cost of acquisition for Rahul for each flat? SDV is 50 lakh rupees, but he is receiving total 6 crores for 10 flats. So 60 lakh should be cost of acquisition. What should I take? Provision says whatever the SDV in the property shall be considered as cost of acquisition. Whatever is the SDV of such property on the date of getting such properties will be cost of acquisition. In this way, we will calculate the capital gain in case of further sale. This was all about your exception to Section 45(1). What four exceptions we did study? First of all was destruction of capital asset. Where asset is destroyed, capital gain will be charged in the year in which such insurance is received. Second point is conversion of capital asset into stock in trade. Transfer amounts when it is converted into stock in trade, but it will be taxable in the year in which such stock in trade is sold. That too, even proportionate amount will be taxable. Third provision says if any property is compulsorily acquired under any law, in that case, it will not be taxable in the year of compulsory acquisition. Rather, it will be taxable in the year in which initial compensation is received, in the year in which enhanced compensation is received. Fourth point was joint development agreement. So transfer amounts in the year in which such property is handed over to developer. But it will be taxable in the year in which completion certificate is being received. These are the four special cases. Now we need to move on to other special cases which are really very important for your examination. So continuing further, now we will be discussing the special cases. Special in terms, these cases are not actually same. These cases have certain peculiarities in them, and you might see at least one of the case in your examination. So these are very important. First of them is ULIP taxation. Sir, what is ULIP? Sir, ULIP is a kind of life insurance policy. It is termed as unit linked life insurance policy. It's a kind of life insurance policy only. A portion of your money is invested in life insurance and remaining portion is invested in mutual funds. So it even grows like a mutual fund, but it also gives you a risk cover. That is the basic provision of this ULIP. How we are going to tax this ULIP? Provision says ULIP shall be taxable if it is not exempt under section 1010D. You don't need to remember anything. You don't need to remember anything. You just need to remember this chart. So we have two types of concept. First is life insurance policy. Second is unit linked life insurance policy. If any life insurance policy whose annual premium exceeds 10%, 15%, or 20% of the sum assured. For example, whatever the sum assured we have, if premium exceeds 10% of that, if premium exceeds 15% of that, or if premium exceeds 20%, depending upon date as specified at the section 1010D, whatever the premium it exceeds, then it will always be taxable under the head income from other sources. It will always be taxable under income from other sources. No argument about it at all. But sir, what if premium is up to 10% or 15% or 20%? Don't remember 15 or 20. Normally it is 10% only. What if premium is up to 15%? Then what we have to say? For ULIP, just you have to check if any ULIP is issued before 1st Feb 2021. If any ULIP is issued before 1st Feb 2021, any maturity on ULIP will be exempt. Any maturity in ULIP will be exempt. But if it is issued on or after 1st Feb 2021, then you have to check aggregate premium up to 2,50,000 rupees is exempt and remaining will be taxable. Any ULIP that has been taken on or after 1st Feb 2021 and whose aggregate premium in a financial year exceeds 2,50,000 rupees, maturity on such ULIP will be taxable. You need to remember this. The taxability under capital gain, it will be exempt under capital gain if it is received on maturity. Any kind of life insurance policy, be it exceeding 10%, be it ULIP, which is taxable, if it is received at the time of death of any assessee, it will always be exempt. Third, we are studying life insurance policy. If we have bought any life insurance policy, we are not talking about ULIPs, we are not talking about ULIPs, we are talking about LIP. If we have taken any life insurance policy issued on or before 1st April 2023, then any premium paid will make the maturity exempt. You need to remember, premium has to be within limit. If any premium is paid within this limit of 10%, 15%, 20%, will make policy exempt at the time of maturity. But if it is issued on or after 1st April 2023, you have to see whether aggregate premium is up to 5 lakh rupees. On all the policies that you have taken, whether aggregate premium in a financial year exceeds 5 lakh rupees, if it exceeds 5 lakh rupees, then whatever policies you have taken to 5 lakh will be exempt and beyond that will be taxable. Whatever policies aggregating amounts to 5 lakh rupees will be exempt and whatever policies exceeding 5 lakh rupees will be taxable. For example, if you have taken 5 policies, one policy is of 1 lakh, 2 lakh, 3 lakh, 2 lakh and 1 lakh. Out of these 5 lakh, you just need to find out any policies which aggregate to 5 lakh rupees. For example, if I take policy 1, 2 and 4, these 3 will be exempt and remaining 2 will be taxable. That means policies amounting to 5 lakh rupees will be exempt and remaining will be taxable. This provision is also saying the same thing, that if any kind of LIP is received at the time of maturity, at the time of death of any person, not maturity, but if any of the proceeds, if any of the maturity is received at the time of death of any SSC, then in that case it will be completely exempt. You need not to tax it at all. It will always be exempt. Got it, sir? Got it? We did get this point. So there is another condition in this LIP portion. There is another condition in this LIP portion. So for example, if I take any insurance, if I take life insurance and pay premium of rupees 4,80,000 rupees, this is X GST amount, and add 18% GST to it. 18% GST, let us suppose it is 90,000 rupees, and payment amounts to 5,70,000 rupees. Now, will this policy be exempt or taxable? Will this policy be taxable or exempt? Right answer is, for the purpose of calculating the limit of 5 lakh, you have to check the amount which is before GST component. Before GST component, you have to check amount, and that will only be considered within the limit of 5 lakh rupees. Got it, sir? Yes, sir, we did get this point. Let us see an example for this. For ULIP 1, ULIP 1 is issued on 1st January 2021. Okay, this is before 1st Feb 2021. Any amount will be exempt, provided that it satisfies the 10% limit. It is satisfying 10% limit. Majority will be exempt. Sum assured is 550 lakh rupees. 10% of 50 lakh is 5 lakh. Yes, annual premium is up to 10% only. That means majority will be exempt in this case. It will be exempt under 1010D. ULIP 2 is issued on or after 1st Feb 2021. We have to be sure about 10% limit also, and 2.5 lakh rupees per annum limit also. Sum assured is 12 lakh rupees. Premium should be up to 10%, that is 1,20,000. Yes, premium is 1,20,000 rupees. That means its maturity has to be exempt, because premium is in limit of 10% and premium is up to 250 only, 2,50,000 only. ULIP 3, sum assured is 13 lakh and premium is 10% of it. That means 1.3 lakh rupees. This means we can simply say that this is also exempt. This is also exempt. Yes, sir, this is exempt. Got it, sir. This policy is taken on 1st March 2021. Now, New Year comes, new financial year arrives, and on 1st April 2021, this person, Mr. Rahul, buys another ULIP of rupees 2,40,000 rupees. Sum assured is 2.4 lakh rupees. Can I say premium is up to 10% of the sum assured? Yes, sir, premium is up to 10% of sum assured. Should this policy be exempt? Right answer is normally this should be exempt, but we have to check one more condition now. If I check previous year 21-22, in April we are paying sum premium of 2,40,000, but in March and Feb we will be required to pay premium of this ULIP 2 and ULIP 3 also now. We will be required to pay premium of these two ULIPs also. In that case, our aggregate premium for a financial year will exceed 2.5 lakh rupees. For previous year 2023, 21-22, we will be paying three premiums. First premium will be 2.4 lakh of ULIP 4. Second premium will be 1.2 lakh rupees of ULIP 2. And third premium will be 1.3 lakh rupees of ULIP 3. Sir, we have to find out 2.5 lakh rupees. Which of the two alternatives should we take for exemption? We can either take exemption on ULIP 4 and make these two taxable, or either we can use these two as exempt and make this fourth ULIP taxable. We can use any of the two options. This is what it is given here. We have option 1, either to make ULIP 2 or 3 exempt, then in that case ULIP 4 will be taxable, because up to 2.5 lakh rupees we have exemption. Beyond that it will be taxable. And other thing, it says either take 2 or 3 taxable and 4 exempt. Either of two you can take. Either you can go for ULIP 4 as exempt and 2 or 3 as taxable, or vice versa, 2 or 3 taxable and 4 exempt. You can take anything. It is completely upon the option with the SSC, whatever he wants to choose. ULIP 5 issued on 30th April 2000, issued on 1st May 2021. Sum assured is 3.5 lakh rupees. Sir, even if premium is within limit, but if it exceeds 2.5 lakh rupees, then it will be taxable. Premium is up to 10% only. Yes, premium is 3.5 lakh rupees, but since it exceeds 2.5 lakh rupees in a previous year, then majority has to be taxable. 6th point talks about LIP. LIP is very critical part. You need to understand this point. Whenever a life insurance policy is issued, okay, sir, sum assured is 1 lakh, 1 CR. So sum assured is 1 crore. And premium per annum is nothing but 6 lakh. Can I say it satisfies the 10% limit? Yes, sir, it satisfies. Of this 10% limit, we need to check whether premium paid exceeds 5 lakh rupees in a financial year. Right answer is yes, sir. Premium exceeds 5,000 rupees. Oh, sorry, 5 lakh rupees in a financial year. That means maturity of this life insurance policy should be taxable because it is issued on or after 1st April 2023. Maturity will be taxable. How maturity is calculated? We need to understand this point. We critically need to understand this point. Let us understand one by one. This ULIP is simple, but life insurance policy na is a bit technical. Just go with me. Just come with me. What I'm saying. For example, on 1st April 2023, I took a life insurance policy. I took a life insurance policy. Yes, sir, we did take 5 lakh 20,000 rupees plus GST 80,000 in totaling to 6 lakh rupees. Life insurance premium. We paid premium for 10 years and maturity amount is 80 lakh rupees. At the time of maturity, since premium exceeds 5 lakh rupees, then it should be taxable. Premium exceeds 5 lakh rupees, it should be taxable. Yes, sir, it should be taxable. So, what should be taxable amount? First of all, take full value of consideration 80 lakh. What will be the cost of acquisition? So, should I multiply 5.2 lakh for 10 years or should I multiply 60 lakh rupees, 6 lakh rupees for 10 years? What should I multiply? What should I multiply? Sir, should I take cost of acquisition including GST amount or excluding GST amount? Right answer is, sir, you should take cost of acquisition excluding GST amount. Why will you take excluding GST amount? Because yeah, you are not considering already GST component in exemption also. You are not considering GST for 5 lakh limit also. So why will you take GST in cost of acquisition? The cost of GST is not considered as cost of acquisition, at least for this purpose. Second important thing what it says is, this is not the sole cost of acquisition. Provision says if you have taken deduction under 80C in any of the financial year. For example, for 10 consecutive years, you have taken 80C. You have taken deduction under life insurance policy mentioned under 80C. Then for that purpose, you have to reduce such deduction from cost of acquisition. For example, for 10 consecutive years, you are taking 1.5 lakh rupees deduction under section 80C. Then that amount should be reduced from cost of acquisition. So for your point, cost of acquisition will amount to 3.7 lakh rupees only. Into 10, this implies 37 lakh rupees will be the cost of acquisition. You get this point or not? Are Baba, did you get this point or not? This was all about your ULIP taxation. Any amount received under ULIP shall be considered. Any premium paid shall be reduced. No indexation will be allowed, and it will be long-term capital gain under section 112. It will be long-term capital gain under section 112. Now we have slum sale. Instead of selling entire undertaking, instead of selling entire business, we are selling off an undertaking of a business. For example, if business has two units, one is retail unit, one is wholesale unit, we are just hiving off the wholesale unit. If a business has two units, software unit, hardware unit, we are hiving off the hardware unit. If business has to have two division, we are hiving off. We are selling off one of the division, and we are not selling the individual assets. We are selling whole unit for a single consideration. It is called slump sale. When you sell an undertaking without assigning selling price to individual asset, it is considered as a slump sale. For a single consideration, you are selling off the complete unit. How capital gain will be determined? It is an important factor. For the purpose of calculating capital gain, you need two things. First is full value of consideration and second is cost of acquisition. Full value of consideration minus cost of acquisition will give capital gain. Important point to note, sir. Sir, full value of consideration is calculated in two ways. First is FMV1 and second is FMV2, and cost of acquisition is calculated by arriving net worth. As soon as you will be able to find out FMV1, FMV2 and net worth, you will be done with capital. You will be done with slump sale. We just need to understand how to calculate FMV1, FMV2 and net worth. Got it, sir. Sir, no indexation is allowed for calculating slump sale. Even after budget, no indexation is allowed for any asset. But even before budget, you are not allowed to index any asset for the purpose of slump sale. For Purpose of determining the period of holding, you must understand that unit must have been held for 3 years to make it long term. Not just before budget, but even after budget, unit must have been held for 3 years. Why, sir? Why every asset has been changed to 2 year of period holding after budget? But slum sale is being governed with Section 50B. And period of holding concept has been changed in relevant provisions, but it has not been changed in Section 50B. So for that matter, slum sale is yet to be checked for 3 years. If any of the undertaking is held for 3 years or more, then it will be long-term capital gain. Otherwise, it will be short-term capital gain. So for slum sale, you still have to check the period of holding as 3 years. Got it, sir? Got it. FMV1, FMV2, and net worth. How to arrive FMV1, FMV2? First of all, let us understand net worth, how net worth is calculated. Whatever assets are being transferred or whatever the assets of the units are being transferred, you just need to check them. All the kind of depreciable assets will be taken at WDV as per Income Tax Act, not WDV as per any other act, WDV as per Income Tax Act. Depreciable assets, WDV as per Income Tax Act. If you have any kind of scientific assets, or if you have any kind of assets which are in the specified business, take it as nil because you have already claimed a deduction on those assets now. If you have any self-generated assets like goodwill, patent, copyright, take it as nil. And if you have any other asset, take book value. For example, if you have any land, debtors, if you have any kind of investments, take it on book value. If you have done any revaluation on such assets, ignore revaluation. Ignore such revaluation. Reduce liabilities at book value, you will arrive at net worth. If net worth is negative, take zero. So whatever, how you will arrive at net worth, take depreciable assets at WDV, take other assets at book value and reduce the liability. Simple as it can be. If you have any goodwill, if you have any patent, copyright, just ignore self-generate patent, goodwill, copyright, it will be ignored. Any kind of asset which is in specified business shall be ignored. How you will arrive at sales consideration? For sales consideration, you have to check for FMV1 and FMV2. Whichever is higher, you will be taking as full value of consideration. Now, what is FMV1 and FMV2? FMV1 talks about whatever assets that you are giving up against the undertaking. If you are selling any undertaking, you must be giving off all the assets now. You must be giving off all the assets. So FMV1 speaks about the fair market value of all the assets that you are giving up. For example, stamp duty value of the immovable property that has been transferred along with undertaking. If you are transferring any undertaking and along with that undertaking, any kind of immovable property is also being transferred, then take SDV of that property. If you are transferring any shares that are there in that unit being transferred, then take fair market value of such shares and securities. If you have any kind of jewelry or any artistic work along with that you along in that unit, take open market value of that jewelry. And whatever the asset remain, take book value. So other than jewelry, other than shares, other than immovable property, take book value of all those shares. This will give you the fair market value of the units transferred. Many a times doubt arises that what if we have, sir, goodwill or such section 35 assets, section 35 AD assets, then they will be taken at book value only. Their value will not be nil in this case. They will be taken at book value. After arriving the assets, WDV of fair market value of the asset, reduced liabilities. Do remember that share capital is not a liability. Reserves and surplus, dividend, provision for taxes, uncertain liabilities, contingent liabilities. These are not liabilities. These are not liabilities. These are simply a part of share capital. These are not considered as liability. You have to reduce liability excluding these components. Got it, sir. Got it. If you have any kind of TDS, TCS, advanced tax, deferred revenue expenditure, just ignore that point. You don't need to consider these points. As once you are done with finding out FMV1, you just need to find out the FMV2. FMV1 talks about what all assets that you are giving up for that consideration. What assets that you are giving up. FMV2 talks about what things that you are receiving. For example, if I am selling a house, FMV1 will tell about how that house is of worth, and FMV2 talks about how much money I am receiving for such house. So FMV1 talks about all the assets transferred. FMV2 talks about amount of money received, that is sales price. FMV of the shares received as a transfer, whatever shares if I am receiving any shares, then take the FMV. If I am receiving any immovable property as a result of transfer, take SDV of that. If I'm receiving any gold or any other asset or any jewelry painting, then in that case, take open market value of that securities and add all of them. You will come up FMV2. Once you are done with arriving FME1, FME2, take higher of them. It shall be considered as full value of consideration, reduce net worth from it, and you will get the capital gain as long-term capital gain or short-term capital. All this is to be done on a valuation date, that is the date of slump sale. SSC is required to get a CA report being furnished up to the due date of tax audit, indicating how net worth has been computed and whether it has been computed correctly or not. How can you avoid slump sale? There are two methods given. First of all, instead of selling off your unit, you can either demerge your unit, because demerger is an exempt transfer. So for that matter, you can demerge your unit so that you can avoid slum sale taxation. Second thing that you can do is, for example, if you want to sell your undertaking to any other entity, you can acquire 100% stake of that entity now. As soon as you acquire 100% stake, it will become your 100% subsidiary, and any asset transferred to your 100% subsidiary will be completely exempt. So if you want to sell your unit, you can either acquire that entity 100%. In that case, what will happen? In that case, any asset transferred will be completely exempt. This is how things will go. Transfer from partnership firm to partner to partnership firm, we'll do it afterwards. Let us complete the remaining cases first, then we'll come on to this topic. Capital asset distributed on liquidation of the company. First of all, I have shares. Company went into liquidation. So my right in the company has extinguished. So for that matter, shareholders' rights are being extinguished. So transfer occurs in the hands of the shareholders. Therefore, in the hands of the company, it is not taxable. Any liquidation is not taxable. But in the hands of the shareholders, we do have taxation. If you remember section 222C, 222C talks about if shareholder receives any kind of asset at the time of liquidation of the company to the extent of accumulated profits, whether capitalized or not, it shall be considered as deemed dividend. For example, if a company distributes 20 crore to the extent of accumulated profit, this 20 crore will be taxable under the head deemed dividend, will be taxable as deemed dividend in the hands of the shareholders. So for the purpose of calculating capital gain in the hands of shareholders, we need to find out what money that shareholder is receiving. Whatever money, whatever the assets that he is receiving, take the total of that. If he is receiving any asset, then take FMV of such assets and amount of money received, shall be taken. Second thing, you have to reduce the amount of interest as accumulated profit of the company. That means whatever the amount that will be taxable as deemed dividend, you have to reduce from it, because it will be taxable under that IFOS now. So how can you take full sales consideration as full? Whatever money or asset you are receiving, out of that certain portion will be taxable under that IFOS now. So you have to remove that component from sales consideration. Therefore, whatever the component that will be taxable as deemed dividend has to be reduced from the sales consideration. Reduce cost of acquisition, that is purchase price of the shares. This will give you capital gain in the hands of. So what I have said, sales consideration minus the amount that is chargeable under that deemed dividend minus cost of acquisition will give capital gain in the hands of the shareholder. Got it, sir? Got it. Section 50 double A, very important section from your examination point of view. If you have any kind of market linked debentures, any kind of specified mutual funds, or any kind of unlisted bonds and debentures, then any capital gain arising from such transfer of such assets will be always short term capital gain. It will never be long term, it will always be short term, irrespective of the period of holding. Important point to note, asset may be long term, but capital gain arising on such assets will always be short term. This is what this provision says. Also, we will not be allowed indexation against any of these assets in any case. See, after budget, after 23rd July, no indexation is allowed whatsoever in any cases. Before budget, indexation was allowed in certain mutual funds, but after budget, no indexation is allowed. And on these assets, we will never be allowed indexation even before budget. We were not allowed indexation even before budget. Therefore, computation of capital gain will comprise sales consideration minus transfer expenses, which will give us net consideration minus cost of acquisition, no indexation whatsoever. And last, it will capital gain will always be short term under section 50 AA. Now, what are those assets that are covered under section 50 AA? First of all is market linked debentures or specified mutual fund or unlisted debentures. What is market linked debentures? For example, Mr. A issued debentures to Mr. B. Mr. A issued debentures to Mr. B. And rate of interest is not specified in mutual funds. Rate of interest is given like Mr. A says, I will give you return 1.1 times of return of Nifty. Whatever return that Nifty gives in a financial year, I will give you 1.1 times more of that return. For example, Nifty delivers 10% return, I will give you 11%. If Nifty gives 50%, then I will give you 55% rate of interest. This is what Mr. A has promised. These are a kind of debentures on which interest is dependent upon an underlying asset, underlying stock, underlying asset, underlying benchmark, underlying index. Interest on such debentures is dependent upon market condition. These are called market linked debentures, and any capital gain on these debentures will always be short term. Second thing is specified mutual fund. These are certain kind of mutual fund which are issued on or after 1st April 2023, whose total proceeds out of the total asset under management, out of the total asset under management, less than 35 of proceeds are invested in equity shares of a domestic company. Less than 35. That means I can simply say these are debt oriented, but even less than 35% of the proceeds are invested in equity or equity shares of domestic company. Got it, sir? Got it. No issue. Third point is unlisted bonds and debentures. See, this point is added with effect from 23rd July 2024. On or after 23rd July 2024, if any unlisted debentures or bonds are either redeemed or transferred, either they are redeemed or they are transferred, any capital gain, any gain arising shall be considered as short-term capital gain only. Any capital gain will be short-term capital gain only. So be it redemption, be it transfer of unlisted debentures or bonds. Unlisted imply which are not listed on recognized stock exchange. So these are considered as unlisted bonds and debentures, and any gain arising on such unlisted bonds and debentures will always be short-term capital gain taxable under Section 50AA. We have transfer of securities held in demat. For example, if I have shares in of Reliance, bought on 1st April 2024 for rupees 1500. On 1st May, I acquired another share for 1600. On 1st June, I acquired another share. Oh, I did not acquire. I did not acquire. I already had I already had certain physical shares of rupees 10 each. Acquired in 1st January 1990. I just got them dematerialized on 1st June on Zerodha. On Zerodha, I just got them dematerialized. On 1st September 2024, I acquired another share of 1650 rupees. Now I have 4 shares. Out of these 4 shares, I intend to sell one. I intend to sell one for 1700. If I sold any such share for 1700, what will be the cost of acquisition? Sir, cost of acquisition should be either 1500. As per FIFO method, it should be 1500. Or either should be 10. Either it can be 10 because it is the oldest share that we have. Or it should be weighted average of all these shares. What should be the case? Right answer is it should not be weighted average. It should not be weighted average, first of all. Second thing, it should be as per FIFO method. It should be as per first in, first out method. That means on whatever date such share enters into the demat account will be considered. So, a first share that was acquired on 1st April 2024 enters into demat, it shall be considered first while calculating the cost of acquisition. It is irrelevant that actually this third share was acquired way before this 1st April, but it got dematted on 1st June only now. Therefore, we have to check the date on which such shares enters into demat account for the purpose of calculating securities held in demat. Capital gain taxable in the hands of the beneficial ownership. Cost of acquisition shall be decided as per FIFO method. FIFO method apply to demat securities and not physical securities. If multiple account are held, then it should be done as per account wise. If we have Zerodha account, Grow account, Angel One account, then FIFO has to be account separately for all 3 accounts. If old securities are dematerialized, then FIFO shall be on the basis of determining the movement out of the account is the date of the entry. For example, if I sold first share, then cost of acquisition will be 1500, despite of the fact that this third share is acquired way before this 1st April. But we have to check the date of entry into account. The date on which this share has been entered will be considered for the purpose of first in and first out, not the actual date of acquisition. Did you get this point or not? Yes, sir, we did get this point. If you have any doubt till now, you can comment down your doubt. I will be responding to it. If you have any doubt, you can come to Telegram channel. I will be more than happy to respond to your doubts. Okay, sir, did get your point. Section 51, advance money forfeited. See, if you have given any advance, if you have given, sorry, if you have received any advance for selling out any movable property, and later on the agreement did not materialize, or sales did not materialize, you are bound to force the advance. See, this is normal trade parlance that whenever you receive any token money, you forfeit that if trade does not materializes. But it's a provision says if any kind of advance money is forfeited on or after 1st April 2014, then in that case it is taxable under income from other sources. That means date from which Modi government came into power, it will be taxable at the rate, simply it will be taxable under the head income from other sources. This is so not the case before Modi government. What used to happen is what used to happen was if any advance money was forfeited before 1st April 2014, then such forfeited advance money was reduced from cost of acquisition. An important point to note, it was reduced from cost of acquisition before indexation. See, for example, if such asset was liable for indexation, for example, if such asset was sold before budget and you were supposed to index it, then you have to firstly reduce the advance money forfeited and then you will index such cost of acquisition. Got it, sir. See, if advance money is forfeited by the previous owner, then you have to ignore it. For example, if I have a house property, if I have house property and I have taken advance money and I have forfeited such money. Now, if I will be selling such property, then whatever advance money I had forfeited will be reduced from cost of acquisition, and then reduced cost of acquisition will be indexed. That is simple the case. But what if I have forfeited the advance money and I have gifted that property to my sister? And now my sister is selling such property. Then in that case, will the advance money forfeited by me will that advance money forfeited by me shall be reduced from the cost of acquisition of my sister? Right answer is no. Right answer is no. Let us understand this example. For example, we have Mr. Jethalal. Jethalal received advance money of 51,000 rupees from Mr. X. Mr. X he received. His cost of acquisition was 10 lakh rupees. Now he did not sell the house. He just gifted his house to his wife Dayabin. And Dayabin sold the house for 1 crore. Now in the hands of Dayabin, capital gain will be calculated as full value of consideration of 1 crore minus cost of acquisition will be 10 lakh. We have already studied if we have received any asset on account of exempt transfer, then cost of acquisition of the prior owner will be taken. In that case, cost of acquisition will be 10 crores, 10 lakh rupees. Will I be reducing advance money forfeited? We have already studied now. Advance money should be forfeited. Right answer is advance money will not be reduced. Any forfeited advance money will not be reduced because Dayaben is not the one who has forfeited this money. Jethalal is the one. So if capital gain is in the hands of Jethalal, then only this advance money will be forfeited. Otherwise, in the hands of Dayaben, it will not be reduced, and flat 10 lakh rupees will be the cost of acquisition in her hand. Did you get this point or not? Yes, sir, we did get this point. This was all about your advance money forfeited. This was all about your advance money forfeited. Now we are talking about a topic which is relatively very important. Relatively very important. This has yet not been tested in examination, but if it is being tested, there are greater chances that you might make certain mistakes. Transfer of capital asset by the partnership firm to the partner. Simply, we are talking about the example. We are not reading the bare provision at all. We are just talking about the example. We'll try to make the provisions as per example. Let's see how things go. We have Mr. Prem. Mr. Prem is a partner in a firm, Extend Company. Okay, fine, good to go. Extend Company, Mumbai. Extend Company has four partners. See, Extend Company has four partners, including Mr. Prem. See, we can assume simply one partner, Mr. Prem, whose profit and shared losses are equally. That means 25% is the partner, anybody. Any partner is 25% holder in PS, and Mr. Prem also holds 25% of the profit sharing ratio. Mr. Prem resigned from Extend Company on 1st April 2024. On 1st April 2024, Mr. Prem resigned. Can I simply say that Mr. Prem resigned before the date of budget? Before 23rd July, he resigned? Yes, sir, he resigned. On the said date, the capital balance of each of the partners stood at 32 lakh rupees. That means on the date of resignation, capital account balance was 32 lakh rupees. Got it, sir, got it. To settle the dues of the Mr. Prem, firm revalues its land for the first time since purchase. At the time of dissolution, at the time of reconstitution, normally partnership firm revalues its property. This general parlance, they revalue. The valuer also values the self-generated goodwill at 70 lakh rupees. The firm has following capital asset for which details are as follows. They have a land in Pune, acquired in 21st January 2013, acquired at 15 lakh rupees, and it has been revalued to 50 lakh rupees. Got it, sir, no issue. There has been increment of 35 lakh, no issue whatsoever. They have a land at Nagpur, acquired in 18th April 2015 for 25.4 lakh, revalued at 45 lakh. This has been reduced to certain amount. Land at Mumbai, acquired in 14th May 2013, acquired at 88 lakh rupees and revalued to 250. And they have self-generated goodwill, which was actually which was not acquired, so cost of acquisition was nil, but it has been valued at 70 lakh rupees. So there has been 80 lakh rupees of increment. In April 2024, that means on the date of the resignation of Mr. Prem, Exxon Company gave land at Nagpur and 15 lakh rupees money to Mr. Prem to settle his capital account balances. What this provision is saying, that Prem was due rupees 32 lakh rupees. 32 lakh rupees was his capital account balance. To settle his dues, firm gave him a land of Nagpur. What was the value of the land of Nagpur? If I am highlighting for you, 45 lakh rupees worth land is being given to him. Plus, he is also given certain cash money. He is given 15 lakh rupees of cash money. You just need to find out the taxation in the hands of partnership firm. Because partnership firm is giving away its capital asset against the partner's share capital account, and capital gain should occur in the hands of the partnership firm. That is very obvious because partnership firm has certain assets. Asset is being transferred, so capital gain should arise in the hands of firm. How capital gain will be calculated? For that matter, Section 9B plays into picture. Section 9B simply says, let us assume this asset is not given to Mr. Prem. 9B asks us to assume that suppose this asset is not given to Mr. Prem, then how capital gain should have been calculated? Understand this point. If this 45 lakh rupees worth land was not given to partner and sold to an outsider, then easily we could have sold this property at rupees 45 lakh rupees, then full value of consideration would have been 45 lakh. Yes. Cost of acquisition or index cost of acquisition. Since it is sold before budget, then cost of acquisition would have been indexed cost of acquisition. What cost of acquisition was? So 25.4 lakh rupees divided by CII of year of acquisition, that is previous year 15-16, it was 254 multiplied by 363 for your attempt. What would have been index cost of acquisition for such property? 36.3. Capital gain that would have been in the hands of the firm would have been this 8.7 lakh rupees. Can you all agree with this point, that if firm would have sold this asset, if firm would have sold this asset to an outsider, then simply this much amount of capital gain firm would have paid. This much firm would have been this much amount of capital gain would have been taxable in the hands of firm. Yes, sir. This much capital gain would have been taxable. Also, firm was liable to pay tax at the rate 20% on such capital gain plus 4% surcharge. 8,70,000 into 20% into 1.04. 1,80,960 rupees was the amount of tax that firm was liable to pay on this capital gain. Can you all agree with this? Can you all agree to this point that if firm would have sold this property to an outsider, then simply it could have earned capital gain of 8.7 lakh rupees and tax would have been 1,80,960 rupees. Can you all agree with me or not? Yes, sir, you all will agree with me. This is nothing but section 9B. Section 9B requires us to compute the capital gain, assuming that it has not been given to a partner, it has been given to any outsider. Section 9B requires us to assume that this asset has not been given to a partner, this asset has been given just simply to an outsider, and whatever capital gain that accrues after selling it to an outsider shall be taxable in the hands of the firm when it is given to a partner. This is the first leg of transaction. What second leg of transaction says? If this asset would have been sold to an outsider, this asset would have been sold to an outsider, what amount of capital would have been of Mr. Prem? What would have been the amount of capital of Mr. Prem if this property would have been sold to an outsider? For finding out the capital gain, for finding out the capital balance, we need to find out what profits that partnership firm would have earned on this sale. What profit partnership firm would have made. So this land was acquired at for this land was acquired for 24.5 lakh, 25.4 lakh rupees, and this is sold at 45 lakh rupees. That means, can I simply say that partnership firm would have made nearly 19 lakh 60,000 rupees? And of this 19 lakh 60,000 rupees, one fourth share was of Mr. Prem. Then can I simply say his capital would have been increased by 4 lakh 90,000 rupees? Yes. If this land would have been sold to an outsider, then firm would have easily made profit of this much amount. See, this profit is as per this capital gain is as per income tax act because we have indexed the cost of acquisition. But in accounting terms, what profit that firm would have made is nothing but 19 lakh 60,000 rupees, and of that 1961 fourth share is of Mr. Prem. Then simply this much amount of capital would have been increased, Mr. Prem. So his capital was 32 lakh rupees, and in 32 lakh rupees, capital gain of 4 lakh 90,000 rupees would have been increased, would have been added to. Less the amount of taxes that was applicable in the hands of Mr. Prem. Sir, 1,80,960 is the amount of taxes divided by 4. What will be the amount of taxes? 180,960 divided by 4. 45,240 is the amount of taxes that Mr. Prem was required, his share of taxes. That means, can I simply say that 32 lakh capital increased by 4 lakh 90,000 rupees of book profit gain minus 45,240, 36, 44, 760. This is the amount of share capital. This is the amount of partners' capital that would have been of Mr. Prem if this land were sold to an outsider. Can you all agree to this point? Can you all agree to this point? That if this land would have been sold to an outsider, then Mr. Prem's capital would have been 36 lakh 44,760. Yes, sir, we all agree to this point. All agree to this point. Because 32 lakh already was his capital. He would have got book gain of 4 lakh 90,000 rupees because 1960 was total gain. Out of that 1960, reducing 4 lakh divided by 4, 490 would have been his book gain, and whatever taxes that he's paying, one fourth share will be reduced. Then his capital would have been 36, 44, 760. Yes, this is so the case. Provision asks you. Provision is pointing a serious question in front of you. Provision says, what was this amount of capital? Provision says, provision is asking you. His capital balance was 3644. Yes. How much money you are giving to him? 45 lakh plus 15 lakh. You are giving him 60 lakh rupees. And how much money was due to him? His money was due to him was 36 lakh 44,760. Why you are paying him more amount? Provision is pointing a serious doubt to your point, serious doubt to your calculation that if this asset would have been sold to an outsider, then then his partner's capital would have been 36 lakh rupees. In that case, he was entitled for a sum of 36 lakh 44,760 rupees. But you are paying him 60 lakh rupees. Why are you paying? You must have got certain benefit from that. Provision is alleging serious doubt on partnership firm. That partnership firm would have got certain benefit from the partner. Then only it is paying much more. Then only it is paying much more. Partner was due 36 lakh rupees, but you are paying 60 lakh rupees. Why? You must have got certain benefit. What is the amount of benefit? You must have got benefit of 23 lakh rupees. Therefore, this is the capital gain in your hands, and you have to pay taxes again on this. This capital gain is applicable in the hands of partnership firm. Because partnership firm is paying much more than its capital amount. And partnership firm must have got any kind of benefit from the partner. That is what the section is assuming. And therefore section requires to pay, but section requires partnership firm to pay capital gain to tax such capital gain in its hand, and whatever the corresponding taxes are, 20% plus 4% will be taxable in the hands of partnership. This taxation is as per section 45b 45.4, sorry, 45.4. First of all, Assume that asset is being sold to an outsider. Calculate capital gain, pay taxes. That is what section 9b says. If that asset would have been sold to an outsider, whatever book value that have been added to partners' capital must be added. Whatever taxes partners were required to pay, it must be reduced. Then his capital balance were to be arrived just before reconstitution, and check what amount you are paying him against that capital balance. Whatever excess balance that you are paying against his capital balance will be taxable, will be charged under that capital gain, will be charged under that capital. Now, sir, there is a serious issue to this point. There is serious issue in this point. What serious issue? So this provision says, if asset is being transferred, if asset is being transferred only once to a partner, we are directly or indirectly taxing it twice. We are directly or indirectly taxing it twice because simply one asset is being given to a partner. We are firstly assuming sell it to outsider and taxing it under 9b. Again, we are assuming we are giving it more than capital, then we are taxing it under section 45(4). We are taxing the same asset twice. It is a serious threat to, it is serious double taxation that must be avoided. Provision says need not to worry. Whatever capital gain you are charging under section 45(4), firstly pay taxes on them. Pay taxes on them. Whatever the taxes are, 20 plus 4%, pay taxes on that. Just pay taxes on that. Whatever the amount of capital gain that has been accrued shall be apportioned to the assets that are being revalued at the time of reconstitution. That means we have, what kind of assets do we have at the time of reconstitution? We have land at Pune, which has been revalued by 35 lakh rupees. We have land in Nagpur, but it is being given, so it is not left with the firm. We have Mumbai land, which has been revalued by 162 lakh rupees, and self-generated goodwill is being revalued by 70 lakh rupees. Three assets are being revalued. First is revalued by 35 lakh, second is being revalued by 162 lakh, third is being revalued by 70 lakh. Assets are being revalued thrice. Three assets have been revalued. So this capital gain will be apportioned to these three assets in this 35 is to 162 is to 70 ratio. 35 is to 162 is to 70 ratio. What will happen to this? We'll study a bit later. Just understand whether, just let's check whether we have done correct or not. Solution 1. Computation of capital gain under section 9b. Assume that this asset would have been sold to an outsider, 45 lakh rupees. What would have been cost of acquisition? Sir, 25 lakh 40,000 divided by 254 into 363. Capital gain was 870. Taxes were 1,80,960. How much capital gain taxes we have arrived? 189.60. Now, what would have been Prem's share of capital? So 32 lakh capital. Then net addition, his capital would have been 36,44,760 before reconstitution. What money that we are giving? Money we are giving 15 lakh rupees. We are giving land of rupees 60 lakh rupees, 45 lakh rupees. In total, we are giving him 60 lakh rupees worth of asset. His capital balance after reconstitution was 36 lakh 44,760. That means we are paying excess of 23 lakh rupees, 23 lakh 55,240. This is excess we are paying. This is capital gain under section 45(4). Taxes are to be paid on this capital gain. Now understand. Land of Pune was of 15 lakh rupees, has been revalued to 50 lakh rupees. There is increase in 35 lakh. If land of Mumbai was 88 lakh rupees, has been revalued to 250, the cap increase in 162. And self-generated goodwill was nil, but increase has been to 50 lakh rupees. Now in this ratio, see 35 upon 267. 162 upon 267, in this ratio capital gain has to be apportioned. Sir, let us suppose capital gain apportioned to Pune land is 3,08,740. What we will do of this apportionment? Understand this point. For that matter, we need to understand second question. What if Mr. Prem transfer? This is less relevant. Third point says, what if Exxon company transfers such land of Pune for 75 lakh rupees on 12th September 2024? What was the Pune land? Pune land was acquired for 15 lakh rupees and revalued for 50 lakh rupees and sold for 75 lakh rupees. How capital gain will arise in hands of Exxon company? Full value of concession on this Pune land will be 75 lakh rupees as it is sold for 75 lakh rupees. Cost of acquisition will be 15 lakh rupees. Yes, because cost of acquisition will not have any indexation. If it is since it is sold after budget, there will be no indexation in cost of acquisition. Yes. Capital gain will be, sir, 60 lakh rupees. Since capital gain is 60 lakh rupees, now provision says whatever the amount of capital gain that was apportioned to this asset at the time of 45(4) will be reduced from this capital gain. That means whatever capital gain that you are paying taxes right now under section 45(4) will be apportioned to different assets, and in future you will not be required to pay taxes to that apportionment. What I am saying is, sir, apportionment of 3 lakh 8,000 rupees to the Nagpur or to the Pune land. What was the apportionment? Apportionment was 3 lakh 8,000 rupees. This much amount of capital gain you will not be required to pay right now. 3 lakh 8,000 rupees will not be required. You will only be required 56 lakh rupees something you will be required to pay. What is the amount? You just need to see. 56 lakh 91,260 will be required to be paid. Provision also says another thing. Provision also talks about another thing. Provision says the same provision apply to AOP and mutatis mutandis. If any kind of asset is being given by AOP to its member or BOI to its individual, then in that case, similar provisions will apply under section 9B and 45(4). Also, to make it very clear, sir, if a partner transfers any assets to partnership firm, then whatever the amount of value of the asset that has been recorded by partnership firm will be full value of consideration and capital gain will arise in the hands of partners. But we have section 9B for two purposes. If any asset has been transferred by partnership firm to the partner on account of dissolution or partner reconstitution, then in that case, section 9B will be attracted. What 9B was? 9B was assume that it has been sold to an outsider, then capital gain, whatever capital gain would be arising, will be arising under section 9B. Assume it, assume as if it is sold to an outsider. But remember, section 9B is applicable only for dissolution and reconstitution purposes only. Also, if you are not giving any capital asset, you are giving any stock in trade, then PGPP will arise in the hands of partnership firm. That is simple case. But section 45(4), that means assume whatever money that you are paying beyond its share capital, that taxability will only arise at the time of reconstitution and not the dissolution. Where any partner receives any money or capital asset or both in connection with reconstitution, not at the time of dissolution. Whatever the money that partner receives at the time of reconstitution, that means this 45(4) is only applicable for reconstitution purpose. So what I said, 9B applicable for reconstitution and dissolution. 45(4) only applicable for reconstitution, not for dissolution. You must remember this point. Okay. It may apply to certain assets. If you are transferring any stock in trade, then in that case, PGBP will also arise. These were all the special cases. What we have studied till now. Just let us recollect what we have studied. First of all, we came with definition portion. In definitions, we studied capital asset. We studied transfer. We studied period of holding concept. We studied rural agriculture land. After definition, we came to computation of capital gain, where we studied normal computation. Then we studied provisos, which was all about indexation, NR taxation, NR non-resident holding, and then 2, 3, 4, 5, 6. We studied about sales consideration, 50C, 50CA, 50D. Then we studied cost of acquisition, how cost of acquisition will be considered for right shares, bonus shares, demerger, spread equity shares, or in case of exempt transfer. Then we came to special cases. Special cases, we have studied two types. First one were exception to section 45(1). There were four exceptions. First one was destruction. Second one was conversion. Third one was compulsory acquisition. Fourth one was joint development agreement. Then we came to special cases, other special cases, which included ULEP taxation, was slum sale, partnership firm to partner. Then we have liquidation. Then we have demat securities. Then we have advance money forfeited. And then we have 50AA. These are the topics that we have studied till now. Now, till now we have understood how to compute the capital gain, in special cases. Now we are about to save the capital gain. By studying the exemptions in capital gain. Section 54. Provision says if any individual or HUF transfers any kind of residential house property. if any individual HUF transfers any kind of residential house property and capital gain on such as property is long-term capital gain, then he can claim exemption under section 54. How can he claim? Sir, he has to acquire a asset. He has to acquire an asset. What asset he must acquire? He must acquire a residential house property in India. And remember, if his long-term capital gain is up to 2 crore rupees, then in that case, he can acquire two residential house properties, but only once in lifetime. This provision is being given to him once in a lifetime. He can acquire two residential house properties if his capital gain is up to 2 crore rupees. So how in within how much time he must acquire? He must acquire either within 2 years from the date of transfer, 2 years, or he can get it constructed within 3 years, or he can either acquire 1 year prior to date of transfer. That means he has acquired first and then selling it. That too is allowed. Sir, if he is not able to acquire within up to the date of ROI, then he must deposit the corresponding amount to CGS scheme. Capital gain account scheme, he must deposit such amount to CGS, then only he can get exemption, otherwise he will not get exemption. What is the amount of exemption that he will be getting? Whatever the capital gain is, whatever the cost of new asset is, whatever the amount that has been CGS or 10 crore, whichever is lower, he will be getting the exemption. Provision says once you acquire any house property and claim exemption on such property, remember that you cannot sell that property for 3 years. There is lock-in for 3 years. There is lock-in for that property. There is lock-in in that property for 3 years. If such property is sold within 3 years from the date of acquisition, then in that case, whatever exemption that you have claimed earlier will be reduced from cost of acquisition on such. For example, if I sold a property for 1 crore and cost of acquisition was say 30 lakh, I had long-term capital gain of 70 lakh rupees and I claimed exemption of rupees 50 lakh. I claimed exemption of 50 lakh rupees, 20 lakh rupees I paid taxes. I claimed exemption of 50 lakh rupees by buying a new house of 50 lakh. In that case, now if I sell this 50 lakh house rupees, a 50 lakh house within 3 years, let us suppose for 80 lakh rupees. Then in that case, this amount will be reduced from cost of acquisition. In that case, if I sell such house, then full value of concession will be 80 lakh only. But cost of acquisition of 50 lakh shall be reduced. The amount that has been already claimed as exemption will be reduced from cost of acquisition. We have already claimed exemption of 50 lakh rupees. This will be reduced from cost of acquisition. Therefore, cost of acquisition in that subsequent sale will be zero. This will be reduced. So there was a case law. What that case law said, that if you have acquired two flats, if you have acquired two adjacent flats, you have acquired them from two different buyers. You have acquired them on different deeds. You have acquired from at a different price. You have acquired at a different point of time. But you are breaking the walls in between and you are making them in one house. Then will that house be considered as one house or two house? Provision says that it will be considered as one house only. Second thing, construction shall include both cost of land or building. For example, you are bound to do construction within 3 years. You are bound to do construction within 3 years. What if up to the end of 2 years, I have only paid money for acquisition of land? Is it allowed? It is allowed. Acquisition of land will also amount to it will also amount to construction. Got it, sir. Got this point. And third point is investment in the name of any other person is also eligible. For example, if I am buying property, I am making the payment, but I am getting it registered in name of my parents. Will that be allowed? Will I be eligible for exemption? Right answer is yes, it will be eligible. If you are paying consideration and getting that property registered in somebody else's name, it is allowed. You will still be allowed exemption. Next section, section 54B. If any individual or HF transfers any urban agriculture land used by him or his parents for at least 2 years for agriculture purposes. What it says, individual HF transfers any urban agriculture land used by him or his parents for at least 2 years for the purpose of agriculture, at least 2 years prior to at least 2 years, then in that case, any capital gain arising will be exempt, can be exempt. But for that matter, you have to acquire something. You must remember, first of all, any capital gain, either short-term capital gain, long-term capital gain, it will be exempt. It can be either short-term, it can be long-term. There is no foundation of being capital asset being long-term capital gain. Any capital gain will be exempt. Important thing is you have to buy either urban agriculture land or rural agriculture land. See, asset transferred is urban agriculture land, but you can buy rural agriculture land from this also. Within 2 years from the date of transfer, it must be bought. So whatever amount If capital gain you want to get exempt, you must deposit such amount in capital gain accounting scheme. How much amount will be exempt? So capital gain, cost of new asset, or whatever amount that have been invested to CGS, whichever is lower will be exempt. Lock-in period is same. If you sold such asset within 3 years from the date of transfer, it will be reduced from cost of acquisition. See, there is one clause in this point. For example, if I sold urban agriculture land, and against that I'm required to buy either urban agriculture land or rural agriculture land. Let us suppose I bought rural agriculture land. Then am I supposed to keep that rural agriculture land for 3 years also? What I'm saying is, if I sold urban agriculture land on 1st April 2024, then for claiming exemption within 2 years, I have to buy either rural agriculture land or urban agriculture land. Let us suppose I bought urban agriculture land or rural agriculture land on 1st April 2025. Now I am required to keep that land for at least 2 years, for at least 3 years. I am required to keep that land for 3 years. What if I sold it? What if I sold it on 1st April 2020, 26? I did not keep that land for 3 years. I sold it on 1st April 2026. Will that be reduced from cost of asset? Right answer is no, it will not be reduced. Why? Because rural agriculture land is not a capital asset now. So there will be no capital gain. So there will be no reduction in cost. There will be no capital gain and no reduction in cost. So this is the kind of tax planning that has been given in your book. Just understand this point. If any urban agriculture land is sold, you have to buy urban agriculture land or rural agriculture land. If you buy urban agriculture land and sell it thereafter within lock-in period, then whatever the exemption that you have claimed will be reduced from cost of acquisition. But if you are selling any urban agriculture land and buying rural agriculture land and selling it thereafter, then no tax implication will apply even if you sell before lock-in period. This is so the case. Section 54D, D. Any person whose land and building of industrial unit has been compulsorily acquired. Any person whose land or building has been compulsorily acquired, but that land and building has been used at least 2 years before the date of transfer. Land or building for industrial unit has been compulsory acquired, and he has incurred any kind of long-term or short-term capital gain on his land or building. Provision says, sir, he can buy new land or building for industrial undertaking, and whatever capital gain was will be exempt. But remember, you must buy such land or building within 3 years from the date of receiving the compensation. Whatever the compensation that you are receiving must be deposited to CGS. Any amount of capital gain, cost of new asset, or CGS, whichever is lower, will be exempt. You must remember, again, lock-in period is same for 3 years. You cannot sell such property, sell such land or building within 3 years from the date of acquisition. Otherwise, it will be reduced from cost of acquisition. No issue whatsoever. Next point, section 54 EC, very important section. Very, very, very important section. Any person. See, why this section is important? Because this is the only section till now in exemption which a company can also claim. In general parlance, section 54D company can claim, but only if it has if it has faced a compulsory acquisition now. Section 54 EC anybody can claim now. Provision says any person. Asset transfer is land, building, or both. Asset transfer must be land, building, or both. It can be land, building, or anything. But remember, such asset must be long-term capital asset. Okay. Then he can get his capital gain exempted if he acquire bonds of certain companies. If he acquire bonds of National Highway Authority of India (NHAI), Rural Electrification Corporation Limited (RECL), or IRFCL or PFCL, then maximum exemption he can claim of rupees 50 lakh rupees. He can claim exemption of 50 lakh rupees. Sir, within 6 months from the date of the transfer, that bond must be acquired. CGS is not applicable because you are directly buying the bonds within 6 months, so CGS the scheme is not applicable. How much exemption that you will be getting? Sir, capital amount of capital gain or cost of new asset or 50 lakh rupees, whichever is lower, you will be getting exempt. So remember, lock-in period is very special here. This provision says those bonds should never be sold, should never be redeemed 5 years. You cannot sell that bonds, you cannot redeem such bonds 5 years from the date of acquisition. Also, very, very, very important point, you cannot convert that bonds into money. That means you cannot use that bonds to give it as collateral and get loan out of it. You cannot do that. It will be considered as converting into money, and it will still be considered as violation to the section, and exemption withdrawn shall be taxable in your hands. If loan is converted into money, it will be taxable. So what if I have made payment within 6 months, but allotment is made after 6 months? Then what will happen? Will I be entitled to exemption? Right answer is yes, I will be entitled. Provision says this was very important case law. In case of VS Dempo, it was, I guess. VS Dempo, what it was verdicted. If business sells any kind of land or building, if a business sells any kind of building, that building is a long-term capital asset. Since building is a part of block of assets, so it faces certain kind of depreciation, and any kind of capital gain arising on the depreciable assets is always short-term capital gain. Remember, capital asset is long-term capital asset, but capital gain is short-term capital gain. This happens only in only a few cases. It happens in case of depreciable assets. It happens only in case of Section 50 AA. Otherwise, this is so not the case. Every long-term capital asset will have long-term capital gain. Every short-term capital asset will have short-term capital gain. But in case of depreciable assets, capital asset may be long-term capital asset, but capital gain can be short-term. Capital gain will be short-term. In that case, if asset is long-term capital asset, will it be entitled to exemption under Section 54 EC, despite of the fact that capital gain is short-term capital gain? Right answer is yes, it will be allowed. Will be allowed. If asset is long-term capital asset, then you will still be allowed exemption despite of the fact that capital gain is short-term. Got it, sir? Got it. Section 54F. If any individual HUF sells any kind of long-term capital asset other than residential house property. Because residential house property being transferred is covered under Section 54. So for that matter, 54F, you can sell any asset. You can sell gold. You can sell any kind of land. Land is also covered. Remember, Section 54F covers land. Because land is not a residential house property. No? If you sell gold, if you sell shares, if you sell land, then in that case, Section 54F will invoke and Section 54F will be applicable. The applicant should be long term, and you must acquire one residential house property in India. How much or if you want to construct that, you can construct it within 3 years. You can acquire it within 2 years, or you can acquire it within 1 year prior to the date of sale. TGS is also applicable because government wants to know where did you spend your money. How much capital gain will be exempted? You just remember whatever the amount of capital gain that you have faced multiplied by cost of new asset divided by net consideration. Whatever net consideration that you are receiving out of such transfer, out of that net consideration, whatever amount of cost of whatever the amount of asset that you are acquiring new will be the ratio for determining the exemption in long-term capital gain. Got this point? Yes, sir, we did get this point. Remember, exemption in this section can be maximum up to 10 crore only. You cannot claim exemption more than that. Maximum exemption allowed is 10 crores. Lock-in is same as this. Of 3 years it must be held. You cannot sell. It shall be taxable separately. Remember, for example, if property is jointly owned, for example, I paid the full consideration and 50% of the property is registered in my name and 50% of the property is registered in somebody else's name. In that case, will I be entitled for complete exemption? Right answer is yes, I will be entitled. For example, if I'm required to get my house constructed within 3 years, and only a petty work is left, only petty work like flooring, floor fittings, pipings, or certain electrical fittings are pending, then will I say that that completion is not that property is not constructed completely? Exemption will still be allowed. This is petty work construction. It shall be deemed construction. Remember, SSC should not hold more than one residential house property at the time of claiming exemption. Provision says if you want to claim exemption under Section 54F, you can only have one property before buying this new property. See, for claiming exemption under Section 54F, you must acquire one house property in India. Before acquiring such property, you can only one property. You can have only one property other than the property that you are going to acquire. Other than that, you can only have one property. Otherwise, you will not be entitled for Section 54F. Yes, sir. Got this point. This point is very special. This point was witnessed in case of Boli Mahadevappa's case. So what was the case? For example, a person sold the house for 60 lakh rupees and cost of acquisition was 40 lakh rupees. The applicant was 20 lakh. Government intervened this full value of consideration and said that 60 lakh rupees was not actually this was not the actual sales consideration. 80 lakh was the actual sales consideration. Why? Because SDV was 80 lakh. So sales consideration would have been 80 lakh. Therefore, capital gain is 40 lakh rupees. SSC agreed to this point. SSC agreed to this point that since SDV exceeds the consideration, SDV exceeds 110% of consideration, then whatever SDV is will be considered as full value of consideration. SSC agreed to this 40 lakh rupees of capital gain. Got it. Now, out of this 40 lakh rupees, he went to claim exemption. For example, he bought house of rupees 70 lakh rupees, house of 70 lakh rupees. Now, how much exemption he can claim? So, simply exemption, he can claim 40 lakh rupees of capital gain multiplied by cost of new asset 70 lakh divided by full value consideration 80 lakh. This is the amount of exemption now. This is the amount of exemption. Yes, sir, this is the amount of exemption. Now, what assessing officer said? How can you buy asset of 70 lakh rupees? Assessing officer intervened and said, how can you buy asset of 70 lakh? Your actual consideration was 60 lakh rupees now. You are yourself putting 10 lakh rupees extra because you have introduced this money separately. How can you claim exemption on 70 lakh rupees if you have not received the 70 lakh rupees on your sale? You are putting extra money and claiming exemption on that also. Assessing officer intervened by saying this. In this case, Karnataka High Court said assessing officer cannot ask from where assessee brought this money. It is not relevant for it is not dependent on assessing officer from where assessee has got the money. Important point is whatever the net concession that has been considered, either he has received that net consideration or that net consideration is on account of SDV. That is not relevant. He can either get that money from buyer also, or he can invest that money from himself also. That is not relevant. Whatever the new asset he is acquiring, he can acquire out of his money, he can acquire out of the buyer's money. That is not relevant. Only thing matters is cost of new asset cannot exceed the net consideration for the purpose of exemption. That is what the condition is. So assessing officer in reducing this cost of new asset amount is invalid. Now we have section 50G and 50G. They both talk almost similar things. We'll study side by side. If any eligible SSC, transfers any land, building, plant and machinery of industrial unit of an urban area. Similarly, if any land, building, plant and machinery of an industrial unit of an urban area is being transferred in both the sections. Remember, both these sections do not talk about furniture. See, you cannot claim any exemption in case of transfer of furniture. You cannot claim exemption on the transfer of furniture. That is the bottom line. What you have to acquire in both the cases, things are different. Plant and machinery for construction or purchase or construction of new plant and machinery in rural area. From here, you are selling from urban and you are shifting to rural, and you have to acquire new plant and machinery. In this case, you are you are transferring from urban to SEZ. Section 50G talks about urban to rural. Section 50GA talks about urban to SEZ. And Section 50C explicitly says new plant and machinery should be bought, but Section 50C GA does not talk about new plant and machinery. Plant and machinery can be second hand also. These are the two differences. It can be bought either 1 year prior to the date of transfer, or it can be bought within 3 years from the date of transfer. Similarly for 15G. Exemption limit, whatever the amount of capital gain or amount invested in CNA. Similarly for 15G. Lock-in period, so 3 years of lock-in. If violated, if assets are being sold within 3 years from the date of acquisition, then it shall be reduced from cost of acquisition. Advance money paid for land or building shall also amount to exemption. Section CGS. See, if investment is not made under Section 54, see, in 54 you are required to buy a new house. 54B you are required to buy urban agriculture land or rural agriculture land. 54D you are required to buy any land or building for industrial undertaking. 54F you are required to buy new house property. In 54G you are required to buy new plant and machinery. But you are required to buy in 2 or 3 years now. In that case, up to the date of ROI, you must deposit the capital gain amount to CGS, and amount deposited to CGS shall be considered as deemed exemption. Whatever money whatever house you will be buying, you must buy that house from that amount only that has been deposited in CGS. That amount deposited in CGS will work as deemed exemption for you. If you did not withdraw amount from CGS, remaining amount will be taxable in your hands. Section 37A, this is very less important section, but it has still been given for the people of Amravati. See what Amravati is. Amravati is not in Maharashtra. Amravati is in Andhra Pradesh. See, Andhra Pradesh got split from Telangana. And whatever the capital Hyderabad was, Hyderabad came into Telangana. So now Andhra Pradesh is left with no capital. Okay. So to develop the capital of Andhra Pradesh, they decided a city called Amravati. And they decided a massive rehabilitation program. They just asked people to vacate their lands and give that land to the government. And for that matter, government will renovate such land, government will renovate such properties and make it a big city. And in return, they will be allotted certain flats once city is developed. For that matter, there were multiple transfers implications. For example, the landowners were required to give their land to the government. That case, transfer will arise. The landowners will be getting land and flat in return of their lands. That will be gift provisions. There were multiple taxation implications. Ease that out, government introduced certain exemptions. Section 1037 provision says if any land or building or both are being owned by SSC on 2nd June 2014, they have to transfer their lands under land pooling scheme of Andhra Pradesh. Transfer will not amount to capital gain. If such land is being transferred by such any person to government, it shall not amount to transfer. Against that land, they shall be allotted LPOCs, that mean land pooling ownership certificate. These are nothing but certificates that in future, whenever city will be developed, you will be allotted certain kind of land. So this is nothing but land pooling ownership certificates. They can sell this LPOCs. If they sell, then exempt. Then any gain will be exempt. Later on, they will be allotted land. They will be allotted property on the basis of such LPOCs. Provision says if any of the property is being allotted on the basis of such LPOCs, that from the end of the two, if such property is being transferred within 2 years from the date of the previous year in which such property is being received, then any capital gain will be exempt. For example, if I am being allotted property on 1st January 2024, end of previous year occurs on 31st March 31st 2030 or 2025. If such property is being sold within 2 years from the end of the previous year of getting possession, that means if such property is being sold up to 31st March 2027, then any capital gain will be exempt on such transfer. But if such property is sold thereafter, then cost of acquisition will be fair market value or stamp duty value as on 31st March 2027. That means the date on which that property is being handed over to the SSC, end of that financial year, and 2 years from the end of that financial year, whatever the stamp duty value of that property is, shall be cost of acquisition, and that cost of acquisition shall be used for calculating further capital gain in the hands of the SSCs. This is nothing but Section 1037. We do have another section, Section 1037. Any urban agricultural land compulsorily acquired, compensation given by RBI, used for individual HF is exempt. But this section is only applicable for individual and HF. Remember this point. This was section 1037, and this was all about your exemptions. What this point on? You get this point or not? Let us start with tax rates. How tax rates are there in this chapter? Beautiful tax rates given. Continuing further with tax rates. See, how tax rates have been determined in this budget is very crucial. Let us first have an overview how tax rates have been changed or how tax rates go. First of all, for section 102A, 112A, 112A, if any asset is transferred before 23rd July 2024, then 12 or then 10% will be tax rate over and above 1.25 lakh rupees. And if it is sold on or after 23rd July, then tax rate will be 12.5%. This 10% has been increased to 12.5% over and above 1.25 lakh rupees. This 1.25 lakh limit is for complete financial year. If you use this limit before 23rd July, that's okay, no issue. If you use this limit later on, that's okay. But this limit is for complete financial year from 1st April till 31st March. Over and above this will be tax rate at either 10% or 12.5% depending upon rate of sale. If any asset is sold which falls under section 111A, then tax rate before 23rd July is 15%, after 23rd July is 20%. If we sell any other STCG, previously also it was taxable at slab rate. Later on also it is taxable at slab rate. If we sell any other asset which is which falls under section 112, then earlier tax rate was 20%. Now tax rate has been reduced to 12.5%. Got it, sir? Got it. Perfect. Perfect thing. You just need to remember this thing. For 112A, 10%, 12.5%. 111A, 15%, 20%. Other STCG slab. 112, 20, then now 12. You have to remember this. What section 112 says, this is important section. Long-term capital gain on sale of certain assets. Long-term capital gain. If you sell any kind of equity shares that are listed on recognized stock exchange, or I should say, if you sell any equity shares on which you have paid STT, security transaction tax on acquisition and transfer, then in that case it will fall under 112A. If you sell any kind of equity oriented mutual funds, or if you sell any units of business trust on which STT has been paid on transfer, then in that case they will fall under section 112A and you will get benefit of 10% over and above 1.25 lakh rupees before budget, or 12.5% over and above 1.25 lakh rupees after budget. That will be the tax rate. And all the securities that are listed on recognized stock exchange will only have STT on it. Otherwise, no other securities are chargeable to STT. That means we can simply say listed securities, listed shares of equity shares, listed equity oriented mutual funds, and listed units of business trust will be taxable under section 112A. What is the tax rate? Over and above 1.25 lakh, before budget 10%, after budget 12.5%. Now we have certain exception, less important, but we have certain exceptions. What it says: in two cases, even though you have not paid STT, you will still get the benefit under section 112. Even if you have not paid STT, you will still get benefit under section 112A. What are those two conditions? First of all, if you have acquired shares before 1st October 2004, see, STT was introduced with effect from 1st October 2004. So if you have acquired shares prior to that date, then STT was not applicable. So if you have not paid STT at the time of acquisition, no, you will still get the benefit under 112A. Second thing, if you have bought shares which are not chargeable to STT, for example, if you bought ESOPs, if I have received ESOPs of Reliance directly from the company, those are not chargeable to STT now. So in that case, if they are not chargeable to STT, in that case, I will still get benefit under section 112A despite of the fact that I have not paid STT. Got this point? Yes, sir. What we have to sell is equity-oriented mutual funds, equity shares, and units of business trust on which I have paid STT. That is simple. That is what we have got. Sir, in three cases, even though you have paid STT, you will not get the benefit. In these three cases, even if you have paid STT, you will still not get the benefits. So, what are those three cases? Provision says if you have acquired listed equity shares which are not frequently traded. If you have acquired equity shares which are not frequently traded, like you have acquired shares which are very less traded, or you have got allotment via preferential allotment, in that case 112 will not apply. But 112 will apply if investment has been made by investment fund, QIBs, NCLT order, SIB order, RBI order. See, normally STT is required to be paid, but in these three cases, even if you pay STT, you will still not be eligible for investment. But in first case, if you are an investment fund or if you are a QIB, then you will be allowed. You will be allowed even if you have not paid STT. Got it, sir. Second point: you acquire shares other than recognized stock exchange. You acquire listed equity shares which are not listed on recognized stock exchange. Even if you pay STT, you will still not be allowed any exemption. You will still not be allowed this tax rate. What I am saying is, I am talking about who are entitled for tax rate under section 112A. For that, you have to pay STT. Provision says if you have not acquired shares through recognized stock exchange, even if you pay STT, you will still not be eligible for 10% or 12.5% tax rate. Got it, sir. But these seven people, even if they have paid STT, they have not acquired shares through recognized stock exchange, they will still be eligible for this tax rate. Provision says if any purchase is being made by the order of Supreme Court, High Court, NCLT, or SEBI, or acquisition is under ESOPs, or if acquisition is by non-resident as per FDI guidelines, if acquisition is under SEBI regulation, if acquisition is from government, if acquisition is under slum sale, or if acquisition is by any investment fund or QIB, then in that case, even if it is being made via other than recognized stock exchange, then in that case also they will still be eligible for this concessional tax rate. Last thing is, if any share is being bought after delisting, before relisting, if a company is delisted from stock exchange and again it is relisted, in that intervening period, if somebody buys such shares and even if he pays STT at the time of sale, he will still not get the exemption under section 112. He will not be entitled for this concessional tax rates. So what I am saying, STT is required to be paid. STT is mandatorily required to be paid for a security to avail benefit under section 112. But in two cases, STT is not required. First of all, when STT was not applicable. Second, on those securities in which STT is not yet available or is not charged. In three cases, even if you pay STT, you will still not get benefit. For example, if you buy shares which are not frequently traded, if you buy shares from other than recognized stock exchange, or if you buy shares after delisting, before relisting, you will still not get the benefit even if you paid STT. If you sell any kind of securities that are listed on recognized stock exchange, if you are if you sold any securities that are listed on recognized stock exchange at the time of sale, then in that case Cost of acquisition for these securities will be considered specially. Cost of acquisition for these securities will be considered in with special provisions. What it says: take the actual cost of acquisition of that securities and take lower of fair market value as on 31st January 2018. 31st January 2018, or sales value, whichever is lower, take it and take the higher of this lower value plus cost of acquisition. You will get actual cost of acquisition for the purpose of computation of capital gain. What I'm saying, cost of acquisition and lower of whichever is higher. Find out the lower of FMV or sales value. FMV or sales value, whichever is lower, you have to find out. Whatever figure you arrive, you have to compare it with actual cost of acquisition. Whatever is higher, whatever you will be getting will be considered as cost of acquisition. Sir, why this provision has come? Just give me a minute. See, what happened is previously securities mentioned under section 112 were not chargeable to tax. They were not chargeable to tax. Arun Jaitley ji introduced long-term capital gain at the rate 10% with effect from 1st April 2018. For that matter, to prevent massive fall in stock market, they gave an option of grandfathering. That means the day on which he was presenting the budget, he was presenting budget on 1st Feb 2018, 2018. So he gave a grandfathering value as on 31st March. Whatever the share price of that security is, whatever the price of that security is on that recognized stock exchange will be considered as cost of acquisition. Because of which, because of which you will be entitled for zero capital gains. You will get zero capital gains till the date of budget. So what ultimately matters is you just need to find out the cost of acquisition, and for finding cost of acquisition you have to compare FMV and sales price, whichever is lower, compared with cost of acquisition, whichever is higher, that will be your cost of acquisition. Now point is, what is fair market value? How will you calculate fair market value? Provision says fair market value you have to consider as on 31st January 2018. In every question, it will be either given to you or you have to find it out by averaging out. You just need to find out FMV as on 31st March 2018. For that matter, if shares, securities, or any kind of business trust unit or mutual funds are listed as on 31st January 2018, if they are listed, then you have to take highest trading price. Highest trading price. Remember, my dear friends, no average, no lowest, nothing, just highest traded price. Second thing, what they want is, if there has been no trading occurred on 31st January 2018, there was no trading, then immediately preceding day on which such shares were traded, immediately preceding trading days on which such share was traded, take highest traded price on that trading session of that trading session. This will give you FMB as on 31st January 2018. What if shares were not listed, or mutual funds were not listed, or units of business trust were not listed as on 31st January 2018, but later they got listed? They were not listed as on 31st January, but later they got listed. What will we do then? Provision says if you have units of mutual fund, take NAV as on 31st January 2018. And for shares or units of business trust, in that case, what will you do? You will take the cost of acquisition divided by CII year of acquisition and multiply by CII year of 1780. That means divided by CII of year of acquisition multiplied by 272, you will get index cost of acquisition, which will work as FMV for such shares and units of business. Did you get this point or not? So if you are selling any shares which are listed, you have to take cost of acquisition as, sir, FMV, sales price, whichever is lower. Whatever you have got, compare it with cost, whichever is higher. This will give you FMV. This will give you actual cost of acquisition. For the purpose of determining FMV, you have to check whether on 31st January 2018 such shares, mutual funds, units of business are listed or not. If they are listed, then take the highest traded price as on 31st January 2018. If they are not traded, if they are not traded on 31st Jan, just take the highest traded price of the preceding trading session on whatever date such shares were traded. If shares were not traded on 31st, if they are not even listed on 31st January, then what you have to do for mutual fund, take the NAV as on 31st January. For mutual fund, for units of business trust and shares securities, what you have to do, take cost of acquisition divided by CII of year of acquisition multiply by 272. This will give you index cost of acquisition, and that will work as FMV. I hope things are clear. What is equity oriented mutual fund? Sir, any mutual fund, if any mutual fund, whatever proceeds it is receiving, whatever asset under management it has, Provision says if 65% of the total receipts, 65% of the total receipts are invested in equity shares of listed domestic company. If if 65% of the total receipts, 65% of the total receipts are invested in equity shares of listed domestic company. What I'm saying is total receipts 65% invested in listed equity shares of domestic company. Then it is equity oriented mutual fund. Second thing, you are not investing in domestic company. You are not investing in domestic company. You are investing in any other mutual fund. Then what it says? If a mutual fund, whatever proceeds it has, is 90%, it should invest in another mutual fund. At least 90% it should invest in another mutual fund, and such other mutual fund should at least invest 90% of its total proceeds in listed equity shares of domestic company. What it says, you are not investing directly in companies, you are investing in another mutual fund. So such other mutual fund should at least hold 90%, should at least invest 90% of its total receipts into domestic shares of a listed company, or listed shares of a domestic company. So directly in listed company, then 65% criteria, the total proceeds. If not directly, then 90% you must be investing into a mutual fund, and such other mutual fund must be investing 90% of its total receipts into listed shares of a domestic company. Then in that case, such mutual funds are called equity oriented mutual funds. Got this point? Yes, sir, got this point. Now we have STCG under section 111A. All the securities that are covered under section 112A, if held for, if they are long term, then it is considered as 112A securities. But if it is held for short term, then it is 111A securities. What it says, if we have any kind of equity shares, equity oriented mutual funds, or units of business trust on which STT has been paid at the time of acquisition and sale, in that case short term capital gain will be chargeable at the rate 15% if sold before 23rd July, or if sold thereafter, then 20% will be chargeable. But I'm saying 15% before 23rd July, and from 23rd July it is 20%. What it is all about, 111 is all about short term capital gain on those securities that are covered under section 112A. That is listed equity shares, equity oriented mutual funds, and third one is units of business trust. Other STCG remains taxable at normal income, taxable like a normal income, completely at the rate at slab rate. Now we have important section 112. For 112, I just need to make you remember certain things. What earlier provisions were, we need to understand this. What earlier provisions were? Before 23rd July 2023. How 24? How LTCG under section 112 was treated? First of all, what assets are covered under section 112? All the assets that are not covered under section 112A are covered under section 112. That means only three assets are covered under section 112A. Three assets, equity shares, equity oriented mutual fund, units of businesses, that too that are listed are covered under section 112A. Rest all the assets are covered under section 112. Under this section, how tax rate goes? 20% for all assets. But you used to get indexation, but indexation was allowed. Indexation was allowed. Second tax rate was available if a non-resident or foreign company used to invest in unlisted shares of Indian company. Then in that case, they were allowed a concessional tax rate of 10% under section 112A, 112 only. And if you hold any kind of listed securities not covered under section 112A. Any listed securities which are not covered under section 112A will be covered in this portion. You were allowed to tax them at the rate 10% without indexation, or 20% with indexation. For example, you are selling any SME IPO, you are selling any other securities on which were not covered under section 112A. You were allowed choice between 10% without indexation or 20% with indexation. These were the tax rates before 23rd July under section 112. 20% with indexation for all the assets. If non-resident foreign company invests any kind of money in unlisted shares of Indian company, then in that case they were allowed 10% tax rate. And for any listed securities other than 112A, you were allowed 10% or 20% as beneficial to you. This was so the previous case, but with effect from 23rd July. Scenario has changed. All 20% tax rates have been subsumed to 12.5% without any indexation. Without any indexation. Non-resident foreign company, they were taxed at 10%. Now they are 12.5%. They are taxed at 12.5%. Listed securities which are not covered above. So now again 12.5%. Everything has been subsumed to 12.5%. 12.5%. But there is a catch. There is a catch. When government introduced when government introduced this budget, there was massive what I should say, massive wrecking in the crowd that indexation has been removed and you are taxing it way much more than what it would have been taxed previously. See, what happened was previously property, immovable property, was taxed at the rate 20%, but indexation was allowed. Now you are taxing it at the rate 12.5%, but no indexation. Which is more beneficial? Which is more beneficial? Of course, if property is held for a very long period, then 20% with indexation is always beneficial. But if property is new, then in that case, 12.5% is more beneficial because you will not get much price by indexation. There was a tussle, na? For immovable property, there was tussle. So government restored indexation. You must have heard government restored indexation, but government did not restore indexation in any case. For the purpose of computation of capital gain, for any property sold after budget, you will not be allowed indexation in any capital asset. In any capital asset, you will not be allowed indexation. Whatever you have heard is correct, but only partially. What I am saying is just listen to me. If you have sold any asset before budget, you were allowed indexation for capital gain computation. If you sold any asset after budget, no indexation whatsoever in any asset, no indexation whatsoever. If you are taxing any long-term capital gain before budget, you were allowed 20% tax rate. You were allowed to pay 20% tax rate. But after budget, since you are not allowed any indexation, you are being taxed at the rate 12.5%. But there is exception. There is an exception. If any immovable property which has been acquired by individual HUF, resident individual and HUF before budget and sold thereafter, they are being given a choice. They are being given a choice that they can pay tax either 20% with indexation or 12.5% without indexation. They are being given. For capital gain computation purpose, no indexation. But for taxation purpose, they are being allowed to choose if tax as per indexation is lower or tax without indexation is lower. Whichever is beneficial, you can choose. But only for properties that have been acquired before budget and only given to resident individual and HUF. This point. Did you get this point or not? If any immovable property is sold after budget, if it has been sold after budget, no indexation for the purpose of capital gain computation. But indexation will be allowed in case of tax calculation. That is, you will be given an option to pay with indexation at 20% or without indexation at the rate 12.5% only for the immovable properties acquired before budget. What impacts it can create in your answers? First of all, your total income will increase. You are not allowed any indexation on the property, therefore your total income will increase, because of which your surcharge limit will now reach faster. Your total income will become higher and you will be required to pay higher surcharge. That's the first thing. Second thing, because of lack of indexation, now there might be a possibility that you may not get rebate under section 87A. Because of that, your tax liability will increase. Third thing, if you were supposed to get any kind of losses because of indexation, for example, if a property is being sold at 10 lakh rupees, the full value of concession is 10 lakh, cost of acquisition was 5 lakh, divided by 100 into 363. Now I used to have losses of 15 lakh rupees. No, sorry, losses of 5 lakh rupees. Cost of acquisition would have been 15 lakh, losses would have been 5 lakh. These losses were on account of indexation, but now no losses you can have. You can only have cost of acquisition of 5 lakh. Your tax will be zero in this case, but you will not be given any losses. Therefore, you earlier, for the losses which you were entitled because of indexation, government has taken away all the losses because of this indexation. I hope you understand what I'm trying to say. These are certain peculiar points which might be tested, and I'm very optimistic about this point being tested in exam. Remember, for all the three sections, 11111A, 112 and 112A, no deduction under chapter 6A will be allowed. Remember, basic exemption limit. What is the basic exemption limit? 2.5 lakh or 3 lakh? This basic exemption limit is being allowed, but only to resident individual and HUF. Only to resident individual and HUF. Remember, but first basic exemption limit will be used from other source, other income, salary income, house property income. First of all, basic exemption limit is to be used from other incomes, and then remaining basic exemption limit can be used against these three income. Can I use basic exemption limit from any other winnings income? Right answer is no, you cannot use. Basic exemption limit is only allowed for normal income, and basic exemption limit is allowed for these three incomes only for resident individual and HUF. For non-resident, you have to pay flat taxes on these income. For example, we have Mr. Rahul, total income 4,80,000 rupees, out of which LTCG under section 112 is 20. LTCG under section 112 is 3 lakh. LTCG 112 is 1.2 lakh, and other income is 60,000 rupees. His basic exemption limit is 3 lakh rupees, out of which normal income is 60,000. Therefore, Therefore, his unexhausted basic exemption limit is 2.4 lakh rupees. Now, for this basic exemption limit, he can use this limit to set off income against income referred under section 112 or 112. He can set off in whatever manner he wants. In whatever manner he wants. So it is more likely now he will be willing to set it off against the income which is chargeable to higher tax rate. He must be willing to set it off against the income which is chargeable to higher tax rate. So he must be willing to set off against this LTCG 112A. It is logical enough now. So what our income will turn out to be, LTCG 112 will be 3 lakh minus 2.4 lakh. It will be 60,000 into 20% tax rate, which amounts to 12,000. LTCG 112A 1.2 lakh rupees. Sir, since it is exempt up to 1.25 lakh, therefore no tax. And normal income, no tax. In total, he will be having taxes of 12,000 rupees, for which he will be getting rebate under section 87A. So no taxes, no taxes. This was all about your tax rates and capital gain. I hope you understood tax rates really well. Now, certain extra points, what it says. If you have any stock held as stock in trade or capital asset, how will you determine whether it is stock in trade or capital asset? If I have shares or securities, they might be stock in trade, they might be capital asset. How will we determine? The determination is important because if it is held as stock in trade, it will be taxable under the head PGBP. If it is held as capital asset, it will be taxable under the head capital gain. Therefore, we need to determine whether it is capital asset or stock in. What points are to be considered while determining whether they are stock in trade or capital asset? As per CBDT, you have to check treatment done by assessee in the books of accounts. Whatever the treatment that assessee does, that you have to find out. If he consider it as stock capital asset, take that. If he consider it as stock in trade, take that. What is the period of holding? If he is holding such assets for very long period, then they are long-term capital asset. They are capital asset only. Don't need to consider it as stock in trade. Third, quantum of purchase sale. If he is regularly buying and selling, there might be a possibility that assets are stock in trade. But if he is not buying and selling frequently, then in that case we can assume it as capital assets. If objective is to earn dividend, then in that case they are capital asset only. But if objective is to earn income out of price fluctuations, then they are stock in trade. These are certain factors that according to CBDT, assessing officer should consider. Assessing officer, what else point assessing officer should consider? See, first of all, if assessee treats such asset as stock in trade, then AO will not interfere. AO will have to accept that they are stock in trade, unless this stance has been changed. Second thing, if assessee hold listed securities for greater than 12 months. See, if you have listed securities you can sell any day. But if you are holding it for more than 12 months, then it is reasonable enough to assume now that you are holding it as capital asset. Therefore, AO cannot force you to pay taxes as stock in trade. AO cannot force you to offer income on such assets as stock in trade or PGBP income. Unless you change your stance, AO cannot force if you have held such asset for at least 12 months. Third thing, AO must consider all these 4 points that CBT has prescribed to determine whether they are stock in trade or capital asset. Last but not the least point, if income is arising from the transfer of unlisted shares, will always be taxable at capital gain, because normally frequent trading of unlisted shares is not possible. Therefore, it will be normally considered as a capital asset only. But if genuineness of the transaction is questionable, or if it relates to shift, if transactions relating to this unlisted shares may be related to lifting of corporate veil, in that case they might be treated as stock in trade. Otherwise, they are capital asset only. Reference to valuation officer. See, if FMV has been determined, if FMV of a property has been determined by a registered valuer, and in that case, there is greater variance in actual FMV and value determined by the AO. Then in that case, AO can refer such case to valuation officer. But in cases where FMV has been determined by a person other than registered valuer, for example, SSC himself declares such as FMV, then in that case, how, or and when AO can refer such case to valuation officer, provision says if AO feels that difference is more than 15% of the value claimed of the assets. For example, AO considers FMV as 50 lakh rupees and assessee has declared FMV as 35 lakh rupees. Since difference is more than 15% or 25,000, then in that case, AO may refer the case to valuation officer, or AO can refer the case to valuation officer in any other condition in which he may deem fit. Whenever he feels it is necessary to do so, he may refer the case to the valuation officer. Certain extra points. What this point says, sir, for example, if you have a land which you have been holding for more than 20 years, but it has just been 1 year that you have constructed a building on such land, and in previous year 24-25 you intend to sell both land and building, then in that case land will be long term capital asset but building will be short term capital asset. Land will be long term, building will be short term. How will you determine what portion of consideration has been for land and what portion of the consideration has been for the building? Provision says you just have to split the consideration on the basis of fair market value of land and building. You have to find out the fair market value of land and building and you have to split it accordingly. Got, sir? Yes, sir, we did get this point. Side pocketing is nothing, but it is as good as demerger only. For example, if we have any portfolio, if you have a portfolio, if a mutual fund house has a portfolio with 100 crores of AUM, which is divided into 1 crore units of 100 each. Now, out of this 100 crore AUM, 80 crore is good investments, which is the main portfolio. But 80 crore is in the bad investment. For example, it has been bad debt only. You still have a hope of being recovery, but that is only bad. For example, you have invested in India Bulls. If you have invested in company named Byju's, you already know that the company is almost dead. You may or may not recover the portfolio. From a person who is an outsider, just think of that mutual fund. That mutual fund NAV is being traded at rupees 100. That mutual fund in that mutual fund unit is worth of rupees 100. But whenever you will be giving 100 rupees to that mutual fund, out of that 100 rupees, 20 crore you are 20 rupees you are paying for bad investments. Just think it from an outsider point of view. If you are paying 100 rupees to a mutual fund house, out of that 80 rupees you are paying for good investments and 20 crore 20 rupees you are paying for bad investments. For that matter, you will not be willing to buy that mutual fund. So what these mutual fund agencies do, they just split this bad investment to a segregated portfolio. So whatever price that you are paying is only for good units. This 20 crore bad investment is segregated and this NAV of 20 rupees is separately mentioned. Now, if you are buying the units, you just have to pay 80 rupees and your money will be in good investments only. So this is nothing but segregated portfolio. Similar calculation is done the way we are doing it for demerger, sorry. How to solve question? Firstly, you have to identify the date of sale, whether the date of sale is before budget or after budget. Based on the date of sale, you have to check for period of holding. If that capital asset is long term, if sold before budget, you have to check different period of holding. If it is sold after budget, you have to check different period of holding. You have to check the period of holding. Third thing, once long term, short term is decided, you have to decide which category it falls. NTCG 112, 112A, or 111A, or other SEC. You have to determine that. And after that, you have to determine tax rates depending upon date of sale. If it is sold before budget or after budget, you have to determine the tax rate. Then only you will be able to complete. You will be able to solve these questions. I hope you got this point. The chapter is not over. We are yet to complete another portion, which is exempt transfer. Section 47. What we have studied till now, just let's have a quick recap. First of all, we started off with definition of capital asset. Then we went to computation of capital gain. Then we went to certain special cases. Then after that, we went to compute the exemptions and capital gain. Then later on, we went to taxing such capital assets, taxing such capital gain. Now we are about to consider certain transactions which can never attract a capital gain. We are about to consider certain transactions which can never amount to capital gain. First of them is distribution of capital asset on total or partial partition of HF. If HF is partially partitioned or wholly partitioned, partially it has been partitioned or wholly partitioned, then whatever assets that are being received by the shareholders or members of the HUF will not attract any kind of capital gain. Simple point it is. It does not amount to transfer. Ideally, it falls within the definition of transfer, but it does not amount to transfer in any case as per section 40. Second thing, transfer of capital asset under gift will by individual or HUF. If any individual or HUF, for example, I, out of my happiness, I just gave a gift to Rashmika Mandana. I just gave my house at Juhu to Rashmika and says, out of my love, I am giving this to you. Provision says, if I am gifting this property to Rashmika, then in that case, this will not amount to capital gain in my hands. But sir, government of India came and brought an amendment to this section, this provision. Earlier, what used to happen is there was no line as such. There was no line as such by individual HF. Like for example, company when used to gift somebody any asset, the company never had any kind of capital gain. For company also, it was an exempt transfer. But with effect from 23rd July or with effect from Finance Act 2024, Government of India introduced another line to this by saying any gift made by individual and HF shall not amount to transfer, which imply if I am giving a gift to Rashmika, it will still be exempt. But now, if a company, if a firm, if a AOP, if a BOI, if a partnership firm, I mean any other person other than individual HF gives any assets or transfer assets under a will, it shall amount to capital gain. This will not be exempt in their hands. Got it, sir? Therefore, this is an important amendment. I want you all to mark it as triple star. It might come in your. Point number three. If company transfers any kind of capital asset to its 100% Indian subsidiary. 100% Indian subsidiary. Any capital asset, then any such transfer will be exempt. Similarly, if such subsidiary transfers any assets to its parent company, exempt transfer, there will be no capital gain. The two conditions are to be fulfilled. First of all, this 100% parent subsidiary relationship should be established for at least 8 years. And second condition, such subsidiary or parent company shall not convert capital asset into stock in trade. Such capital asset should not be converted into stock in trade by either parent or subsidiary. These two conditions should be fulfilled by both parents or subsidiaries. Otherwise, whatever exemption claimed will be taxable in the hands of the prior party. Exemptions in case of amalgamation. For example, Blinkit amalgamated with Zomato. Blinkit amalgamated with Zomato. Now, what all transfers they did take place because of this amalgamation? Just understand this. For example, I am Rahul. I held certain shares in Blinkit. Now, Blinkit amalgamated with Zomato. What transaction did happen with me was all my shares of Blinkit were taken away and I was given shares of Zomato. Forcefully, all my shares were taken away and I was given shares of Zomato. Provision says any surrender of shares by the shareholders of amalgamating company will be exempt transfer, first of all. Any surrender of shares by the shareholders of the amalgamating company to the amalgamated company will be exempt transfer. But remember, consideration should be in shares only, nothing else. Yes. Now, Blinkit is transferring its asset to Zomato because it is being amalgamated with Zomato. So, all the patents, copyrights, assets, whatever Blinkit had will be transferred to Zomato. In that case, such transfer of assets will also be exempt. Third point. For example, if we have a company named Facebook, Facebook holds 10% shares in Jio, Reliance Jio. Now, what if this Facebook merges or amalgamates with Meta company, Meta? Now, all the shares of Geo, which were previously held by Facebook, are being transferred to a new company called Meta. Will it amount to transfer? Right answer is no. This will not amount to transfer. So, if any shares of Indian company are held by foreign company and such foreign company amalgamates with any other company, provision says it shall not amount to transfer. This will be an exempt transfer. And fourth point, it says transfer of capital asset by assets in banking company with banking institution. For example, if any banking company amalgamates with any banking institution, for example, corporation bank amalgamated with union bank, in that case any transfer shall be exempt transfer provided that amalgamation should be as per Banking Regulation Act. Next point, transfer under demerger. Sir, for example, of this Reliance company, Geo Financial Services is demerged. Then out of this 1,000 crore net assets, 100 crore net assets are being taken by Geo Financial Services. In this case, provision says any transfer of assets from demerged company to resulting company will not amount to transfer. Second thing, for example, Rahul held one share of Reliance, which was acquired at the rate 1500. Now, value of this share go down, and he received a share of Geo for which is worth rupees 100 rupees, and the share of Reliance is 1350. Share of Reliance fell down by 150 rupees because value that has been taken by Geo is reflected in Geo shares price. Provision says whatever the value that has been reduced of Reliance share, that will also not amount to. Third point, if there is a company called Meta holds shares of Geo 10%. Meta holds 10% shares in Geo. Of this Meta, a company demerges called Facebook. Company demerges from Meta called Facebook. And of the total assets transferred from the Meta, shares of Geo are also transferred to Geo Facebook. From all the total assets that Meta had, 10% of the assets are being transferred to Facebook. And 10% of the assets include shares of Geo Financial Services also. So in that case, now the owner is Facebook. Now the shareholder is Facebook. Meta is not the shareholder. In this case of demerger, provision says if transfer of shares of Indian company are being done in case of demerger between two foreign companies, then in that case, this transfer will be exempt transfer, provided at least 75% of the shareholder continue to be shareholder in the resulting company. That means at least 75% of the Meta must be shareholder in Facebook. So in this case, any transfer of shares will be exempt to transfer. This is the definition of amalgamation and demerger. You may leave this definition. Provision says redemption of sovereign gold bonds. Sovereign gold bonds by individual SSC. So sovereign gold bonds are nothing but gold bonds which reflect the price of the gold. You can directly invest in gold or you can directly invest in SGB. What happens is SGB, in physical gold, you pay making charges, you pay GST, you do not get any return like other than appreciation. But in SGB, you are not required to pay GST, you are not required to pay any making charges. You get interest per annum 2.5% also, and they are even issued at a bit discount. But these are the benefits of having SGB. As the prices of gold increase, similarly prices of SGB will also increase, and they have a certain maturity, and after that maturity, whatever the prevalent prices of gold are will be given to you on that maturity date. Provision says any kind of maturity of zero coupon of sovereign gold bonds for an individual is exempt. Any capital gain that you might have in case of that SGB will be completely exempt. If you are transferring that SGBs before maturity, what will happen? Then before budget, you are even allowing indexation on these bonds. See, normally indexation is not allowed after budget. In this also, but after budget, you will not be allowed indexation. But before budget, if you transfer such SGB, you were allowed indexation. Normally, indexation is not allowed on bonds, but on sovereign gold bonds, you were allowed. Transfer of capital asset under reverse mortgage scheme. This is important. Scheme what it says. For example, this is Mr. Rahul, age 70, no family, but a bungalow. But I have a bungalow. No family, but I have a bungalow. Now I want monthly income. Now what I will do of this bungalow? I want monthly income just to spend, just to visit Thailand. What will I do of this bungalow? So provision says need not to do anything, need not to worry. You can go to a bank and you can give this bungalow to bank. And against this, you will be given monthly compensation of 80,000 rupees for rest of your life. Rest of your life. When you will die, this bungalow will transfer to bank. See, normally what happens is in mortgage, we get the house first and you have to pay EMI every month. But in this case, what is happening? You have the house, but house will transfer after 20, 30 years. And you are getting EMI. You are getting EMI. So you are not paying, you are getting EMI. So this is nothing but reverse mortgage scheme. In this case, provision says if such house is being transferred to bank, this will not amount to transfer. No capital gain will be attracted in the hands of Rahul. Second thing, whatever monthly installment he is receiving, that is completely exempt. Third thing, when bank will further sell this house, then in that case, bank will attract the capital gain. Of this is the basic funda of reverse mortgage scheme. Any asset transferred under reverse mortgage scheme is completely exempt. Any compensation received is also exempt. See, as per SEBI guidelines, if we transfer any securities under stock lending scheme, for example, if I do not have any securities, but I have a conviction that market will fall. So I lent stock from my friends, I sold it down, I again bought those shares, booked profits, and returned those shares to my friend. In that case, whatever the transaction me and my friends are having, me and my friends it took place, it might appear that shares have transferred. They have given possession of properties. Then in that case, transfer, it might appear that transfer has taken place. Provision says any kind of transfer in case of stock lending scheme will not amount to transfer. If I have any art, if I have any archaeological collection, manuscript, book, photograph, or print, which I give to any government, university, national museum, art gallery, or archive, it will be completely exempt. If I give free of cost, then to exempt. If I charge any money, then to it will be exempt. Transfer of shares of SPV in exchange for units of businesses. What this point says, understand this point. Sir, for example, if we have business trust called if we have a business trust and it invests at least 51% in shares of SPV, then only it is business trust. A business trust is a business trust only when it is investing in SPV. No, it holds 51% in SPV. So it might be possible na 49% are being held by somebody else. For example, Rahul holds rest 49%. Still this SPV is still this business trust is a business trust. The rest 49% are being held by Rahul. Now Rahul received an offer from this business trust. Rahul received an offer from this business trust. What Rahul received is, Rahul, surrender your shares. Surrender your shares to this business trust, and what you will get in return, you will get units of business trust. Understand, for Rahul. Rahul is giving away his shares in this SPV, and he is receiving units of businesses. Ideally, this amounts to transfer, but provision says any transfer of shares of SPV in exchange of units of businesses is exempt under Section 47. We'll discuss about this in more detail in chapter Business Trust. Capital asset: if predecessor cooperative bank transfers any assets to successor cooperative bank, if infra finance company transfers any assets to institution established for financing, or if any public sector company transfers any asset to public company approved by central government, then in that case this will be exempt transfer. Mutual fund related exempt transfer, what these provisions says. See, if two equity oriented mutual funds combine, equity oriented plus equity oriented mutual funds, for example it is Kotak and it is Nippon, they both consolidate, or I should say Nippon equity classic fund or Nippon equity growth fund. They both are equity oriented mutual fund. If they both consolidate or one merges with the other, then in that case, just imagine, for a unit holder, I was holding units of equity oriented classic fund, equity or Nippon equity classic fund. My units are forcefully taken away from me to give the units of equity oriented growth funds, no, Nippon equity growth fund. Should this amount to transfer? Right answer is it amounts to transfer. As per definition of the transfer, it should amount to transfer. But provision says this is an exempt transfer. But only exempt if consolidation is between either two equity oriented mutual funds or either two debt oriented mutual funds. If consolidation happens between equity and debt, in that case this exemption will not apply. Second exemption: if we have two mutual fund in the same class, consolidation between the plans. For example, if same mutual fund has dividend plan, has growth plan, and it merges both the plans, then in that case whatever the transfer is, it will be exempt transfer. Next point: if any sole proprietor, if any partnership firm, or if any AOP converts into company, or any AOP converts into recognized stock exchange, or I should say company only. If anybody wants to convert into company, then all the assets of the proprietor, partnership firm, AOP will go to company now. In that case, it should amount to transfer. Provision says this will be exempt transfer if following conditions are satisfied. What following conditions? Understand this. If all the assets and liabilities are transferred to company, if all the assets of the proprietor are being given to the company, if all the assets of the partnership firm are given to company, Consideration received to proprietor or partners or members is only the shares of the converted company. For example, I was the proprietor. I gave all my assets to the company. What I should get? I should not get any money, because if I am getting money, then it is actual sale. But if I am getting shares of that company, then it is conversion. So I should not get anything other than shares of company. Third thing, shareholding of previous proprietor or member should not be at least less than 50% within 5 years from the date of the conversion. For example, Rahul is having proprietorship firm. It converted into company and holds 100% of the shares. Provision says you must maintain at least 50% till the within 5 years from the date of the conversion. 5 years. You can sell certain shares, you can sell certain of your shares, or some of your shares, but at least continue to hold a minimum 50% up to 5 years from the date of the conversion. You must hold at least 50%. Okay, sir, got this point. Provision says for sole proprietor, he shall be only shareholder in the company. For sole proprietor, he can be only shareholder. Sir, but it will become one-person company. He can have one share as nominee, one person as any other person as nominee shareholder for one share to comply with the minimum member requirement. But he should be the only shareholder in the company. And for firm AOP, members must be allotted shares in proportion of their share capital outstanding on the date of the conversion. On the basis of the share capital, members must be allotted share capital. Also, if we have corporatization of stock exchange, which implies if AOP is converted into stock exchange, then in that case, it should be in accordance with the SEBI guidelines. These things are to be considered to make this transfer as exempt transfer. Otherwise, it will be taxable. What if, sir, unlisted company converts into LLP? Can it do so? Yes, sir, it can do so. All the assets of the unlisted company will transfer to LLP. It will be exempt transfer, but only if certain conditions are fulfilled. First of all, which unlisted companies can convert it to LLP? Only companies which fulfill both the conditions. Only unlisted companies fulfilling these two conditions can convert themselves into a LLP. Otherwise, not every company can convert. If total receipts, total turnover or gross receipts of the company is less than 60 lakh rupees in last three preceding financial year till the date of conversion. That means for previous year 24-25, you have to check previous year 23-24, 22-23, 21-22. If for all the 3 years turnover must be lesser than 60 lakh rupees, and sir, total assets of the company should be up to 5 crore rupees in three preceding financial year till the date from the date of the conversion. Turnover total assets should not exceed 5 crore. Total assets should not exceed 5 crore. If a company fulfills both the conditions, then in that case this company is eligible for conversion, and once this company converts, it should satisfy all the conditions to get this conversion as exempt conversion. All assets and liabilities transferred to LLP. All the assets that company has should be transferred to LLP. Okay, no issue. All the shareholders become partners in capital contribution, and PSR should be in proportion of the shareholding. For example, whatever share capital I have, I should become partner in the company, and my PSR should be dependent upon my shareholding. So for shareholders, all the consideration should be in profit share in profit only. If if I am a shareholder in company, what I should be getting? I should be getting nothing but share in the profit. Total PSR in LLP of the shareholders should be at least 50% up to 5 years from the date of the conversion. This is important. Okay. Once this company is converted into LLP, it might be possible that new partners may come, existing partners may go. Provision says whatever the number of members that were in the company, at least they must hold at least 50% of the profit sharing up to 5 years from the date of the conversion. They must hold at least 50% of the profit sharing. Whatever the members were in the company, at least they must continue to hold at least 50% of the PSR from the 5 years from the date of the conversion. Last point, it says no amount should be paid directly indirectly to the partners from the accumulated reserves standing on the date of the conversion. See, if your intention was to take out the reserves from the company, therefore you are converting, provision says you just have to log the date of the conversion. You just have to log the date of the conversion, and no amount should be taken off from the reserves. See, whatever amount you are willing to take out from the reserves, it is considered as dividend. It's considered as dividend. So, in order to avoid dividend taxation, you are trying to convert this company into LLP. Government says we will not allow this. Provision says we will not allow this. If you want to convert your unlisted company into LLP, either take the money out and pay dividend first and then convert, or either you cannot use this accumulated balance. You cannot distribute any money Any partner, any member cannot directly, indirectly take money out of this accumulated balance that is standing on the date of the conversion. On the date of conversion, whatever the accumulated balance is, partner member cannot use it. If any of the condition is violated, then exemption of the proprietor will be taxable in the hands of company. So whatever exemption that was taken by the proprietor from capital gain, it will be taxable in the hands of the company. Conversion of securities, a triple star point. So if conversion of bonds, debenture stocks into shares of the same company. For example, I have debentures of a company and such debentures are being converted into shares of the same company. It is exempt transfer. If preference shares are converted into equity shares of the same company, exempt transfer. If physical gold is converted into electronic gold, it is exempt transfer. In case of non-resident, understand this point. Understand this point. But if any non-resident have bond or GDR referred under section 115 AC, if such bond and GDR are being sold by a non-resident to a non-resident, it is exempt. If any RDB, rupee denominated bond, is being sold by non-resident to non-resident, it is exempt. If any government securities is being sold by non-resident to non-resident, it is exempt. All these are exempt, exempt, exempt. Last point, it says, if any of such non-resident sells such bond, GDR, rupee denominated bond, RDB, to person located in IFSC, then also it will be exempt. This point you can leave. We'll study this point if with NR taxation. Otherwise, you are done with all the points. Last point says, whenever there happens an exempt transfer, what will be the cost of acquisition? For example, I have a property. I just gifted it to my sister. It will be exempt transfer for me. She is receiving this at free of cost. So whenever she subsequently sells such property, what will be her cost of acquisition? Provision says cost of acquisition of the previous owner. Cost of acquisition of the previous owner. What will be the cost of improvement? If she does any improvement, provision says whatever improvement she has done will be considered. Whatever improvement previous owner has done will also be considered, because it is an exempt transfer now. So improvement done by previous owner will also be considered. What will be the period of holding? So period of holding held by her will be considered. Period of holding held by previous owner will also be considered for considering long term or short term. Indexation, important point. If I am gifting my property to my sister, it is exempt transfer for her. Now, if she's selling it later on, whether indexation will be allowed or not. Sir, first of all, if it is sold after budget, no indexation will be allowed. No indexation whatsoever will be allowed. But, what provision says? If it is sold before budget, then she will be allowed indexation. She will be allowed indexation. What will be the cost of acquisition? Cost of acquisition will be the acquisition of the previous owner. Cost of acquisition will be previous owner. It will be divided by CII of year of acquisition. Sir, year of acquisition of my sister on me. Sir, it will be my sister. But as per Manjula Jesha case law, it can be CII of year of previous owner also. Sir, for what I am saying is, in previous year 1/4/2001, Rahul acquired property. Cost was 10 lakh. On 1st 4 2007, he gifted the such property to his sister Soumya. And Soumya sold this property for rupees 1 crore. Now, what will be capital gain? Full value consideration will be 1 crore. Cost of acquisition will be of previous owner 10 crore. Multiply by 363 divided by what I will do, CII of 01 12, or will be CII, we will take CII of 078. What will be the denominator in case of indexation, if indexation is available? Provision says as per bare reading it should be 78, but you will not do 78. Whenever you will be indexing, you will be using index number of previous owner, cost of acquisition of the previous owner, CII of year of previous owner, because it was witnessed in Manjula Jesha case law. It was witnessed in Manjula Jesha case law that if any property is acquired on account of exempt transfer, then we can take indexation from previous owner also. So you will get all the answers amended. Whatever answers that you are having in your book are already amended as per this Manjula Jesha case law. Whatever on solutions that you will be doing is correct on this judgment. This was all about your chapter capital gain. I hope you really enjoyed this chapter. What all videos you all want, do comment down. I will be more than happy to make videos on such chapters also. We'll continue this series, and I hope you share this video to most of your friends so that they can also get benefit from this series. I'm really enjoying this session. I hope you are also enjoying the session. Do comment down your experience. We'll see you guys in the next one. Signing off. See you, Rahul Satija. Bye bye. Take care and enjoy.